In 2 months, we've seen a historic melt up.
We still believe that most of what's powering the market is going to be earnings.
It's kind of the opposite of a bubble.
The near-term outlook for all the tech space is actually looking very, very good. The issue really is sentiment.
Volatility works both to the upside and the downside.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Wednesday, finding a firmer footing. The global tech trade stabilizing, heading into earnings from Micron. As South Korea's SK Hynix is looking to raise almost $30 billion. Debt investors taking a cautious view of SpaceX's debut bond offering. A little pushback slowly emerging.
The pricing a little bit cautious, maybe treating this not quite as the BBB rated company that some of the rating agencies were talking about, at least because investors demanded a premium over benchmark rates to own this debt. The short end of the maturity is fine. 30-year space debt, people not so excited. It's just as interesting because everybody has their hand out. SK Hynix lining up next, and frankly, other IPOs coming down the line probably will get followed on by more debt offerings.
Yeah, I'm tracking the same thing. You're seeing these signs of pushback here, there, and everywhere against companies issuing more supply, debt or equity. You're seeing signs of pushback against additional spending. Look at the stock price of, say, Meta or Microsoft right now. Where you're not seeing any reaction, though, companies are still looking to raise capital. Companies are still looking to spend. How much longer can that tension brew in this market?
Right now, when you talk to people in the market, they say quite a bit longer because a lot of these borrowers are agnostic to price to an extent. I mean, rate hikes, we don't care. The idea of a little extra premium, we can handle it because right now it is an idea of amassing a war chest of money that is going to potentially power them into an existential future that to them is either you are a winner or you are non-existent. And right now, because it is still an existential race, people seem willing to keep on borrowing.
We've got a race for capital, not just yet a competition for capital. The Treasury market in mind when I'm thinking of that. 10-year yields this morning down about 2 basis points, the 10-year around 450. Here in New York yesterday evening, Scott Bessent, the Treasury Secretary, here's the quote. Bond markets have taken out more governments than howitzers. I believe the president has complete confidence in the Fed chair to do the right thing.
He's basically saying Trump understands this and is going to make sure that the Fed is independent. And he alluded to the fact that Trump had already said this when he was swearing in during the swearing-in ceremony of Kevin Warsh. Basically, what Scott Bessent came out and said is what we have been talking about this administration since Trump walked back into the Oval Office for his second term, that the bond market is going to be the greatest almost control and pushback on any policies that potentially are not market friendly.
Scott Bessent, again, was the market whisperer, saying that right now I endorse what is happening in the hawkish turn that has allowed long-term yields to come down. So bugger off. President Trump isn't going to push back because this is the way we got to work. And ultimately, it is the bond market that we have to respect.
And he did it here in New York, which is notable. We'll spend some time on that a little bit later. Big gut check coming later this afternoon. Micron earnings on deck. Coming up on the programme, we'll catch up with Aaron Cannon of Clear Harbor Asset Management. As equities bounce coming into that, Tobin Marcus of Wolfe Research as the Mamdani effect sweeps New York primaries. And Dan Ives of Wedbush looking ahead to those Micron earnings. We begin this hour with stocks gaining some ground following a 2-day tech rout. Aaron Cannon of Clear Harbor Asset Management writing, we're still in the early innings of the AI build-out. History suggests that transformative technology cycles are rarely linear. Aaron joins us now for more. Aaron, good morning.
Good morning.
What do you think is upending this tech trade right now? If I can use that word, just introducing some jitters into the trade.
Yeah, I mean, certainly we've had equity supply enter the market. We have earnings season for Q1 that's come to an end, was super strong, 26% annualized growth rate. And now we have a little bit of a lull after Micron this afternoon, that is, in earnings. So I think the rate of change is going to be challenging for the market to sort of parse through and to contemplate on earnings for Q2. You know, can they really keep pace with this sort of 20+% earnings growth rate or not? And then you have overbought conditions. You have a lot of momentum out there. And you've had, the SOX index, the semiconductor index, up, 90% this year, up 150% over the last 12 months, up 300% over the last 5 years. So, huge moves there that are just sort of forcing some investors to take some pause.
Elisa, myself, many others have called this a great wealth transfer from the hyperscalers to the semis. Those hyperscalers, some of those major spenders are under pressure in the equity market, not performing well right now for a variety of reasons, but that is one. If they're underperforming, should the semis too?
Yeah, it's a good question, Jonathan. I think, you're right. Hyperscalers, I think, over the last 12 months are sort of unchanged now. But you take a look at what's going on there, and I think there's a question around, are we going to have a little bit of a lull in free cash flow growth coming out of the hyperscalers? A lot of debt issuance, some equity issuance. But this is early innings, in my opinion. And I would argue that, one of the concerns around hyperscalers is the semi bottleneck. Look at high bandwidth memory, for example. The three largest contributors there to the manufacturing of that: Samsung, SK Hynix, so Korea, and then Micron. And you have growth there on the memory side, on the demand side, that is, of like 30 to 50% annualized, but there isn't a lot of incremental new supply, and they're sold out this year, they're sold out next year. So could we have sort of demand exist, but really the bottleneck will be the supply side, and that could constrain some of the hyperscalers. And then lastly, to what extent is some of this build out within the LLM world and within the co-agentic world going to become more commoditized, more of a utility, or is there going to be true differentiation? A lot of experts are on both sides of that debate right now.
And as we're all in that debate, nobody really wants to get out, but also people are feeling a little bit squirmish about what exactly is happening, which is the reason why you see sort of a rolling ball of cash through different sectors of the market. Yesterday, we saw the S&P down more than 1%, but the majority of constituents were actually up on the day. Yeah. Is that healthy?
Well, it was interesting. I think the equal weight was down only about 35 basis points yesterday. To your point, about a little less than 60% of the constituents within the S&P 500 were up yesterday. So it was a positive sign. The attribution of performance year to date, Lisa, 9 out of the 10 stocks that are contributing the most to S&P 500 performance are semiconductor companies. Some may be a little bit of a hyperscaler smell to them, like Amazon, for example, or Alphabet, but they're all semiconductor companies. And so, yes, I mean, I think if we see a broadening, that would be a healthy sign in this market.
Could you see a broadening with rate hikes?
I think so. I'm not calling for rate hikes anytime soon. I don't think we see 25 and done if there are rate hikes. Usually it's a 75 basis point move or more. And my view is that Fed Chair Warsh is taking a very cautious, yes, incrementally hawkish approach to the rate hike cycle. But it also gives him wiggle room. He's being tested by the bond market. Twos are at 420. The upper bound of Fed funds is at 375. So the market's sort of saying, okay, Fed Chair Warsh, you're probably going to have to raise rates between now and year end. We'll have to see. Employment is strong, and the end of hostilities in the Strait of Hormuz, we could see inflationary pressures actually disinflate over the next couple of months. That could give him some wiggle room to stay on hold, and perhaps if we actually see employment weaken further, although it's accelerated recently, maybe he ends up pivoting to the other side and become a little more dovish. That's not our base case right now. We think the on hold makes sense.
On hold for this year, and then what about for next year?
Well, I think what we've heard from Fed Chair Warsh is let's look at the data. Let's look at the data. Where is inflation? Does AI go from an inflationary force to a disinflationary force over what period of time? Do we start to see the disinflationary pieces? Fed Chair Warsh has talked about this. He anticipates this. I suspect it's going to take several quarters before we get to AI becoming disinflationary, because if you look at AI's penetration into the enterprise, it's less than 1%. So that S-curve suggests that we have a lot of room for AI to penetrate corporate America and the world.
Even if we were to have Fed hikes, would that slow down the AI momentum build out and trade?
Probably not, but I think the challenge the Fed has is what areas of the economy would Fed hikes actually hinder? People who want to buy homes, people who need a loan for their car purchase.
It's part of the market already suffering right now.
Yeah.
Right.
Which begs the question, what's the point?
Yeah.
And Chair Warsh basically addressed that in the news conference. If you ask me the question, do I think we are restrictive right now? If I look at housing, yes. If I look everywhere else, probably not. And if you look everywhere else, and you've basically answered the question when Anne-Marie asked it, what's going to happen to hyperscaler spending or the CapEx if they do raise rates, and it's not going to make a difference. Right. So why are we thinking about hiking rates?
Well, the market is testing Fed Chair Warsh. I would argue where the hawkishness will probably be seen will be on the Fed's balance sheet, that we could see an acceleration of QT, and that's where I think Fed Warsh probably wants to go with this before he starts putting, the hawkish gear in place. I think we're going to see more hawkishness on the rolling off of the balance sheet.
It sounds like you like bonds, and right now this is a good bet given some of the uncertainties and valuation around stocks.
Bonds haven't done a thing in 6 years. Since June of 2020, bonds are unchanged. Total return since June of 2020, unchanged. However, where were 10-year yields in 2020? They were at 70 basis points. Today, they're almost at 450. They were yielding negative real rates. Today, they're about 225 basis points. Yes, we have challenges with deficits to GDP. We're very concerned about that. Net buying of our trading partners has been incrementally going towards the gold trade rather than the Treasury trade. And so we're aware of that. But if you look at the real rate with break evens at 222 this morning and 10s at, like I say, about 450, there's some interesting sort of what I'd like to call, maybe refer to as like a margin of safety there, so that if you wanted to dip into the market right now, you at least could do it based on historical norms. There would suggest there's a little bit of opportunity for.
Can I ask you though, Aaron, as we talk about the additional debt supply coming from corporate America, does that compete now with the Treasury supply? We had a Treasury problem even when we didn't have all this supply. Now we have additional supply. Are they competing with each other?
I think so. I mean, I think that the safe play has been to own the front end of the market, whether that's short-dated high-yield credit, which looks very attractive here. You have the curve that's reasonably flat, 420 in 2s, 450 in 10s, and you have investment-grade credit spreads, which are tight, but also, providing a little more of a cushion, and default rates seem to be, quite healthy right now. So, I do think investors, institutional investors, are going to be looking across treasuries into investment grade. I think central banks, and large institutions will still be dabbling within the Treasury market, and certainly will not be, making a risk-reward decision on high yield versus Treasuries.
Lisa, to your point, you saw that as some of the short-dated SpaceX debt in the last 24 hours.
Yeah, people were okay with that. That was actually the best bid space because, again, you can count on some of the promises holding true for the next 2 years. 30 years, I don't know.
Further out along the curve.
I want to point something out. I just took a look at how long the railroads in the United States took to pay for themselves. 20 to 30 years. At what point are we talking about the disinflationary kinds of ramifications of some of the hyperscaler debt and some of the semiconductor build-out? Something to think about. I mean, I know it's different scope than 20 to 30 years, but there is a payback period of time.
It's very different in more ways than one. That's a defined railroad to somewhere.
Correct.
Right? If you ask someone what we're doing with this, what's the destination?
Mars.
They struggle to describe it. That's very different.
No, it's true. The people actually say this is completely different because we don't know what the ultimate goal is or what the world looks like when it is more efficient on the heels of AI.
Aaron, it's good to see you. Thank you, sir. Aaron Cannon there of Clear Harbor Asset Management. Futures right now in the S&P just about positive. Going into earnings from Micron later on this afternoon. Let's get you an update on stories worldwide. With your Bloomberg Brief, Vonnie Quinn has more. Hey, Vonnie.
Hey, John, good morning. We start with earnings as well, with FedEx trading lower in the pre-market. The company reported fourth quarter results that beat expectations, but warned of inflation and trade headwinds. FedEx forecasting higher adjusted earnings this year as its turnaround effort continues. SK Hynix filing for a U.S. IPO, the company looking to raise more than $29 billion to meet memory chip demand. SK Hynix expects to start trading on July 10th. Now, shares are up more than 300% in South Korea this year. President Donald Trump ordering the DOJ to look into gas prices. The president posting on Truth Social, the big oil companies are not dropping their price at the pump commensurate with the sharply lower prices they are paying for oil. In other words, customers are being gouged. And that is your Bloomberg Brief. John.
Vonnie, thank you. More from Vonnie in about 30 minutes' time. Up next on the programme, the Mamdani effect.
Over a year ago, the odds were stacked against another young Muslim socialist.
We need a good neighbor. We need someone who will always have our back.
Our team of progressive champions is growing tonight.
Up next, we'll catch up with Tobin Marcus of Wolf Research, live from New York City this morning. Good morning. stocks positive by about 0.1% on the S&P, coming off the back of 2 days of losses on the S&P 500. On the Nasdaq this morning, up by 0.5. Ugly session yesterday for the semis. The Philadelphia Semiconductor Index down by close to 8% at the close. Heading into a gut check for this trade. Micron after the closing bell.
Yeah, a lot of people saying that this is a particularly high bar, considering that 5 of the 6 earnings reports that previously have come out from Micron have led to down days on the shares. So even when they beat expectations, their shares tend to go down just simply because when you're on a moonshot in terms of the stock performance, it is very hard to deliver in reality.
That's the equity story. Let's get to the bond market picture. 2s, 10s, 30s. Yields this morning stable. 2s around 420. 10s around 450. An endorsement again coming from the Treasury Secretary here in New York City at the Economic Club in New York for the Fed chair, Kevin Warsh.
For the Fed chair, and also saying that Trump understands bond markets have taken out more governments than howitzers, basically saying we are going to let the Fed chair be independent. To Lisa's point, he's almost whispering we're on board with what Kevin Warsh is doing, even though he came out very hawkish and interviewed as a dove.
I think he understands, Besson certainly understands, that if this Fed chair is overly dovish at this point, treasuries don't rally. They sell off, and we have a different problem. You need to have a commitment to getting inflation back towards target to stabilize the bond market. There is an appreciation of that, at least in the Treasury, for now.
Right now, if you're just looking at the market and you take a look at the most important benchmark yield, which is the 10-year, it has gone down since the Fed has come out with a more hawkish statement. So from this particular perspective, in some ways, they've eased monetary policy, at least when it comes to things like mortgages.
The move in crude has helped as well. WTI 71 this morning on WTI crude. We're down another 2%. Brent crude at 75. Under surveillance this morning, need to talk about New York politics. The Mamdani effect.
Over a year ago, the odds were stacked against another young Muslim socialist. I see a New York that we can all afford.
It's been thrilling as he has been showing us what it looks like to fight for a New York City everyone can afford.
We need a good neighbor. We need someone who will always have our back.
Our team of progressive champions is growing tonight.
So here's the latest this morning. New York City Mayor Zohran Mamdani flexing some political muscle. 3 candidates backed by the Democratic Socialists winning their congressional primaries last night and ousting 2 incumbents. Bloomberg's Tyler Kendall has the latest. Good morning, Tyler.
Hey, John, good morning. Well, these results could double the number of Democratic Socialists in Congress because in the predominantly blue city, the winners of these primaries are heavily favored when it comes to the general election. Voters advanced 2 members of the Democratic Socialists of America who were endorsed by Mamdani in New York's 7th and 13th congressional districts, which included unseating one Democratic incumbent who currently serves as the chair of the Congressional Hispanic Caucus. He wasn't the only incumbent to fall, as we saw Dan Goldman, who represents New York's 10th district, which includes Wall Street, and who, by the way, has one of the most liberal voting records in Congress. He lost his bid for re-election to former mayoral candidate Brad Lander, who had Mamdani's backing. Now, these contexts exposed both the ideological tensions, but also the generational tensions within the Democratic Party right now, because we saw some party leaders like Hakeem Jeffries see his endorsed candidates not advance after last night. Now, John, attention is likely going to focus more on the more contested races in New York State next. That includes the district held by Republican Congressman Mike Lawler, who after last night is now set to face a former Army officer, Kate Conley, in the election come November. I bring up that seat because it is one of those districts in New York that Kamala Harris actually won. It is going to be a race all about affordability. In fact, I got quite literally flashbacks to the SALT cap debate from last summer, which Mike Lawler put himself in the center of, all in a bid to get to this point heading into November.
Tyler Kendall with the latest in Washington. Tyler, thank you. Let's go with the words of Mamdani here in New York City. We need a good neighbour. Let's talk about one of our neighbours. One of the candidates that won last night, their own words on social media reportedly, that they reached for the American flag to wipe their hands because they didn't have a napkin. They're the kind of candidates getting support here in New York City.
Also things like we should abolish borders completely, individuals who, whether you agree with it or not, but led protests that were anti-Israeli protests that many viewed as maybe anti-Semitic here in New York City. Yes, these are very left wing of this party. And they are, even to Tyler's point, beating out individuals who were liberal But this is left of those liberals that New York has been sending to Congress.
Well, let's talk about the national stage. This is what Tobin Marcus of Wolf Research has to say. These wins were uniquely rooted in actual organising by NYC DSA, which does not exist anywhere else. And the personality of Mamdani doesn't exist elsewhere either. Tobin joins us now for more. Tobin, good morning. Is there a takeaway then for the national platform?
Good morning. Certainly, I think there's some read across here. Obviously, this is a striking set of wins with Avila Chevalier in particular beating Espaillat. A very big surprise, big upset. And as you were just alluding to, some very extreme views from her that voters were able to get their heads around. But this is a very unique electorate. I think when you look at, talking to people in the DSA, their ambition is maybe this can translate to other big cities. But I don't think anyone, even within the wing of the party that made this happen last night, is really expecting this to translate to your kind of typical district, which is in the suburbs where most people in America live. So, there's going to be a really vocal, interesting, new, very far left contingent of people in Congress as a result of this. But it's only so far that that's a bellwether for the entire party.
How does Hakeem Jeffries deal with this? Not just in New York, but of course in his leadership role in Congress.
Yeah, assuming he wins the speaker's gavel, as most people expect, he's going to have a real challenge on his hand. It's going to be a very fractious caucus. It already has been. In the opposition, he's done a good job keeping Democrats together, but that's sort of running the House on easy mode, where all you really need to do is get people to align in opposition to the president. When it comes to actually doing something affirmative, there's a real challenge about what it is that they're even trying to do, particularly given how policy light the Democratic campaign is this year, as they really want to stay laser focused on Trump. And he does not have the kind of track record and stature that somebody like Pelosi had as an untested new leader. So, yeah, he has a real challenge ahead of him.
Playbook this morning says the new king of New York, and it's talking about Zohran Mamdani, given his backing of these candidates that won. I think the writing was on the wall, if you've been paying attention to New York City politics, that this is where it was going. Is this awkward, given how close we've actually seen the relationship between the New York mayor and the president of the United States?
Yeah, it was really, really, really striking how well that first meeting between Mamdani and Trump went. And certainly they seem simpatico in certain ways. But they're obviously not actual political allies. There's been some tension over foreign policy since then. I certainly think that President Trump is going to have no compunction in teeing off on the extreme views of some of these candidates who just won primaries, and he'll be happy to make them the face of the party to the extent that he can, since he really wants to run a midterm campaign against Democrats being extreme and out of touch on issues like immigration and crime in the first place. I think these are very much the kinds of targets he'll be happy to have in Washington.
Tobin, are you surprised that turnout wasn't higher?
No, not really. I think that there were some comparisons going around to turnout last year in the mayoral primary, but that obviously was highly contested at the entire citywide level. Here there were relatively high pockets of turnout in some of these contested primaries. Including both the big socialist wins, but also NY12, where it looks like Michael Asher will win. But typically, it was only about 10% turnout in 2024 in the congressional primaries then, and I think we're going to be north of that here. Ultimately, these are they're party primaries. The turnout for them is not all that high, even with a lot of organizing around them in New York.
Tobin, appreciate your time, as always, and your perspective, sir. Thank you. Tobin Marcus there of Wolf Research. In some ways, you might argue that this exposes the difficulty this party will have finding a candidate through the primary process that can actually succeed on the national stage in the general in a few years' time.
This is going to be the big challenge. And you can see that in places like Pennsylvania, where moderate candidates won the Democratic primaries. But you can see in local pockets, very much you see a more extremist push. Then how do you win a cohort of people who skew a certain direction? And this is really the question and the reason why we're asking how much this can represent the mainstream.
And to Tobin's point, this is why he thinks this is a New York issue and it's not going to go mainstream across the nation.
Coming up on the program, we'll catch up with Dan Ives. We'll talk about the tech trade, Wedbush. Dan Ives is going to join us to talk about Micron as they face a crucial earnings test later on this afternoon. Equity futures bouncing back by a little more than 0.1% on the S&P 500. Weakness yesterday for technology stocks worldwide, including the high-flying ship stocks as well. Semis. The semi index down by close to 8% at the close. The biggest losing day we've seen in about 2 weeks for that index, going into earnings from Micron a little bit later. We'll spend some time on that in just a moment. Let's turn to the bond market board. Switch at the board and get to 2s, 10s and 30s. 2s just hanging in around 419.70. We've talked lots about the Federal Reserve. Let's talk about the data. PMIs at the headline level, pretty decent. Just yesterday.
This is the reason why people actually see the likelihood of rate hikes, even with oil prices coming down, because there is this increasing momentum in the underlying economy. And frankly, core PCE is going to give you a sense of that tomorrow. If we do get the headline level of 4% that a lot of people are expecting, this PMI boom that we're seeing in terms of manufacturing and services as well just feeds into the idea that this can continue.
We've said this a number of times, I know, but it's worth repeating. This conversation is still going on even with this move in crude. This move in crude is not leading to fading rate hike bets. In fact, rate hike bets have firmed up, if anything, over the last week. Brent crude at 75. Bear in mind where WTI was at the end of February, high 60s. So we're really close, a few dollars away from wiping out the post-war rally on crude this morning.
Yeah, what's interesting is you're hearing a different tone from Christine Lagarde over at the ECB, who seems to be backing away from the potential for more rate hikes and saying, well, this might actually change
things. ECB's a basket case and has been for a number of decades.
But what's interesting is in the United States, it's the opposite. It's saying, look, this is something we can manage, even as we hear a different tone from the White House.
Well, it's because we have inflation elsewhere. And that's really the AI build-out, even though they are going to be able to look through the rise of energy prices when it comes to oil. Maybe not enough for the president to be able to look through at this moment politically, but right now it looks like the Fed could potentially look through this.
Brent crude right now 75.81. As we count you down to the open about 3 hours away, let's get you some single names, some morning movers. Yahara has more. Hey, Yahara.
Hi, John. We start with the AI chip maker Cerebras. Shares are falling nearly 13% in the pre-market after its first earnings report as a public company, and the results were solid. Its revenue topped expectations, and its full-year sales forecast came in above Wall Street estimates. But after a blockbuster IPO, the biggest in chip history, and a solid run-up in the stock since then, it failed to live up to Wall Street's high expectations. Another casualty of high expectations is FedEx. Those shares falling 7% in the pre-market despite a profit beat and a solid sales outlook. But with the shares up 30% year to date heading into the report, also failing to live up to high expectations. And on top of that, management warning that tariffs and inflation continue to be a headwind for the business. And we end on Micron. Those shares are rebounding 3.8% today after a 13% sell-off yesterday. Made it one of the worst performers in the S&P, but that's now behind us, and all eyes turn to earnings after the bell, with revenue expected to nearly quadruple from a year ago, while profits are forecast to be more than 10 times higher than a year ago. So expectations, no doubt, sky high for this name, which is the biggest contributor to the S&P's rally this year.
Massive move year today, Yahara. Thank you. Thank you for the update. More on that stock in just a moment. On our radar this morning, SpaceX raising $25 billion in debt after drawing nearly $90 billion in demand. The bond's priced wider than similar debt offerings, with investors demanding a premium for the company's heavy spending ambitions. Elsewhere, Morgan Stanley becoming the latest firm to count redemptions for its $7 billion private credit fund. The company limiting withdrawals to 5% after investors sought to cash out over 11% of units outstanding. And finally, the Treasury Secretary, Scott Bessent, signaling confidence in Fed Chair Kevin Warsh.
I am confident that the Fed Chair will optimize the path for both inflation and economic growth. And the President said that at the Chair Warsh's swearing in that he would be independent, that he should do what he wants.
Bessent going on to echo Warsh's belief in the Fed getting inflation back down to its 2% target.
Yeah, perhaps implying, though, that there's a little less pain required in terms of rate hikes in the process. Well, he did say, yes, bond markets you've got to respect. They've taken out more governments than howitzer is a fantastic quote. He went on to say, now that we are, I believe, on the other side of this conflict, talking about Iran and the United States, gas prices will come back down, inflation will come back down to target. So are these completely the same messages, which is rate hikes will bring inflation to target, or is it that inflation will go back down to target, and then we can reassess the message.
What also I find interesting is that he wants to see inflation back down to target, but then is he going to, which he has in the past, brought up the idea that maybe the Fed needs to change how they target inflation. It shouldn't be straight 2%. In the past, he's talked about, obviously you have to hit the goal first before you move the posts, but talking about maybe it is appropriate for the Fed to target a range of maybe 2 to 3%.
I said this yesterday and I'll repeat it. I've got the luxury of not making a call. I don't need to make one, so I have this luxury. I understand that. I'm trying to stay really open-minded about this Federal Reserve. I believe this will be a very different institution, which might introduce a bit of volatility between now and through the rest of the summer. But let's see where we end up by the time we get to the end of August. Kevin Walsh has just got in the seat. There's a number of task forces. I know there's a number of jokes around those task forces, but there's a bit of work to be done to work out what the future of this institution will actually look like. And I'm not going to fill in the gaps with rate hike, just because we have a chair right now that's not offering us much guidance.
At the same time, we are hearing from other Fed officials who are saying rate hike and are offering plenty of guidance. And you've talked about this plenty, talking about how that's filling the vacuum. I agree with you. I also think that it is not controversial on Wall Street and in markets more broadly that some of these things should be reassessed, like exactly what inflation target we're going to be looking at, what the role of the balance sheet is going to be. All of these things are actually really key questions. The biggest one, AI and its ramifications on the labor market and on inflation. These are really key questions. I welcome the task forces.
Ditto.
Please deliver the reports to my inbox.
I feel like you want to run one. You bring it up all the time. It's like you're throwing your name in the ring.
If you want
to think about it, we're criticising the new guy. So many people are. Let's think about the old Fed. Why was the Fed in a position where it needed to go through all these different things before they actually started hiking interest rates, that you needed several sequences to go through to move guidance, to end QE, and then to think about hiking interest rates once inflation was already a problem? Why do you have an easing bias in a statement that you can't remove straight away? Why was it there to begin with when you have a situation emerging in the Middle East that totally upended the outlook for inflation for a lot of people? That's the mess we need to address here. The hand-holding coming out of GFC, GFC's done, it's over. The communication apparatus that came out of GFC, it's done, it's over. You need to address all those things.
I think just on a broader level, just to zoom out, it's a good time to do that because this is a new economic era with a lot of different factors overlaid on top of each other. And a lot of people have said, with a lot of different cycles kind of overlaid on top of each other, it's very difficult to get clean signals. A good time to reassess.
Let's talk about the new era. Let's talk about tech, the tech trade. Steadying ahead of Micron earnings due out after the close today. Shares up more than 250% so far this year. Dan Ives of Wedbush writing, there is some added nervousness on the important memory chip trade. We continue to believe that in this market, we will continue to go through a number of gut check moments. Dan Ives of Wedbush joins us now for more. Dan, good morning.
Great to be here.
Is this one of those gut check moments?
It is. Look, and I think you saw it with the Kospi down 10%. Look, the golden child of this tech boom. A lot of it's in Korea in terms of memory chips. When you think about what's happened with SK and obviously Samsung, and SK overtaking Samsung, Micron, such an important quarter relative to what we see in terms of demand. Ripple, what does that mean for NVIDIA, hyperscalers? But I continue, look, our checks in Taiwan, in Korea, no cracks in the armor. And that's why I just continue to believe third inning, one out in terms of the AI game.
Further downstream, though, you're starting to see some pushback to price. Increasingly. Does that upend some of the story?
Look, I think on the edges that could, but look, right now, demand to supply, call it 12, 15 to 1. In terms of where we are relative to chips. So my view is like, you still, even if you had some events to even take some demand off, you don't have an equilibrium probably for another year and a half, 2 years, which in my view just continues to believe like the chip trade is what you continue to own. Look, hyperscalers, obviously right now those were kind of in the penalty box to some extent, but you will see some push against price. But it's our view, like over time, price comes down. It's all part of what we're seeing with tokens.
Profit margins, though, kind of a key point here because profit margins have been just going to the moon. They've been incredibly robust at some of these semiconductors, in part because they can charge whatever they want. And that's changing. You are seeing some competition with Google and with Amazon coming into the fore. At what point do you start to see those margins really compress?
Look, I think right now, if there's a pressure point, you probably don't see that for another 9, 12 months. But just like you said, like competition's coming across the board. It's an arms race, you know, really when you think from what Meta's doing to Amazon to Microsoft. You have software companies that now they'll start to produce chips. Look what's happening even on the Intel side with Apple. So that will definitely start to pressurize the situation. But in my view, it just continues to be like we are still so early relative to the build out. And that's also why you're going to have these gut check moments. You'll have these white knuckle periods. But we continue to view these as opportunities where you own the AI winners.
Well, the AI winners, though, is the key point here. How do you know who they are when they're shifting around so quickly? And I say this, I thought one of the most interesting stories was when Microsoft came out and they said that they were going to be using DeepSeek to lower the cost of deploying some of their large language models. I mean, is this indicating that cost is now a much higher factor on the list for a lot of these big tech companies when it comes to who they're going to go with?
Yeah, I think it's obviously technology, scale, but cost clearly plays in. There's also the models. Over time, the models are going to get cheaper and cheaper. I mean, the value, if you actually start to think about it, it's in the data, it's in the chips, less about the models, which is why ultimately Anthropic, OpenAI, they're so focused on enterprise, compute. They're focused on all these partnerships because essentially what's happening is everyone's building out their own moat or their own fort. And that's why it's a game of musical chairs, because eventually someone's left without a chair. Now, who are those losers? Look, that's our job, that's other people's job in terms of trying to understand who the winners are. Because you are starting to see a separation in terms of you can't just own the space. You can't just own, it speaks to our view. You have to be selective relative to owning the winners and making sure that you're not sitting owning a loser.
When it comes to enterprise, though, isn't Anthropic way ahead of OpenAI?
Look, I think Anthropic clearly, from a model perspective, I mean, it's their world, everyone's paying rent relative to what they've done, but that gap could be narrowed quickly. I mean, OpenAI is just not going to sit there on a treadmill. So OpenAI, they had their bullseye on their back, Anthropic, but you see what's happening with Anthropic, like, in terms of going after talent from Google. It's this arm, because a lot of it is going to be, it's about the engineers. It's about compute power. And that's going to drive more and more debt raises, equity raises, and that will be also tests for the market in terms of how it handles it.
I haven't seen you since the president briefed me and a few reporters looking into, maybe doing something, public-private partnerships in these companies. What do you make of that, government taking a stake? Look,
I think it's selectively, it's important if it's done the right way. Because you could argue, if you think Intel now, I mean, they're obviously in a glorious situation. Look where they were a year and a half ago. If government doesn't take a stake there, which ultimately led to NVIDIA and more. Now you look at Lip and Intel, they're core in terms of the trade. When it comes to quantum, I think that's really important in terms of some of the government initiatives. And I think IBM and Arvind have been kind of front and center there because what's happening in China because of this arms race.
Can we finish on two losers, Meta, Microsoft? What do I do with those names now? They're in bear markets. Yeah. Everyone's getting all bulled up on the tech story. Two of the biggest tech names on the planet are in a bear market. Yeah. What do you do with those names now?
I think you have to separate them out. Microsoft, I think, is the most oversold large cap name. Just my view, have they made stumbles on Copilot and some other areas? Yeah, but in terms of enterprise, their backyard, Azure growth, compute, supply issues, I think that's ultimately a stock that, $550 stock. So I actually think that continues. Just like a year ago, the narrative on Google was so negative. Look where we are now. From Meta, look, it's a prove me. Like right now, like they're going up Mount Everest without, oxygen or whatever. What they're trying to do, that will be the prove it moment for Zuck as he ultimately tries to go and change the model. I think they're going to be successful doing it. But you can't just spend on CapEx and not show any results.
Dan Ives at Wedbush. That stock is a struggle, that's for sure. Dan, thank you. Meta, a struggle. Microsoft, a struggle. The equity market doing OK more broadly. Equity futures this morning up by 0.25% on the S&P. With an update on stories worldwide this morning with your Bloomberg brief, Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. President Trump trying to ease concerns about Iran's use of its unfrozen assets, saying they can only be spent on food and medical supplies from the United States. Iran's foreign ministry saying Tehran can use the money in whatever way it wants. Alibaba suing the Department of Defense, seeking to be removed from a blacklist that identifies it as a supporter of the Chinese military. The e-commerce giant argues it was added to the list without substantial evidence, violating due constitutional process. In sports, Cristiano Ronaldo becoming the first player to score goals in 6 different World Cup tournaments. Ronaldo ending his scoring drought with 2 goals in Portugal's 5-0 win over Uzbekistan, giving him 10 career goals now in the World Cup. A long way to go. That's your Bloomberg Brief. John.
Bonnie, thank you. Thank you very much. I'm really trying to bite my tongue around the World Cup.
Yeah, but?
I'm enjoying it.
Yes.
I'm enjoying it.
But?
There was a social media post from Tom Brady yesterday, and it said, best World Cup ever. And I was like, yeah, you know what, I'm enjoying it, but let's be very open about what's happening here. We've got 4 quarters now, which isn't just about ad revenue. I think it's about maintaining intensity of the game. You've got an expanded tournament, which means you have lower-ranked teams playing higher-ranked teams almost all the time in the group stage, which means you get this total mismatch that generates drama in either direction. If the minnow manages to eke out a draw, fantastic entertainment. If you get 5-0 Portugal Uzbekistan, fantastic entertainment, right? So the core football viewer, myself and others, are going to watch the World Cup, going to enjoy the World Cup. This is about expanding the game and breaking into the US, and I think they're having success. People like Tom get to enjoy watching Portugal beat Uzbekistan 5-0.
Are you not entertained?
Right? You see what I mean?
Are you not entertained?
Right?
Look, and also it's hard to, I mean, like when you go back to some of those Brazil, like 1970, it's hard. When we put, I mean, Pharaoh's taught me.
They're going to expand the tournament again,
World
by the way.
Cup.
Oh,
it's also.
It's going to be like across 7 continents.
When Ronaldo came out and said, I'm back after the game, and I was like, dude, you were playing Uzbekistan. No offense to Uzbekistan, but like
41.
the bar was not there.
I'm enjoying it, but it's about the product, right? And the product. It's about getting the product palatable for a different viewer, the non-core audience.
The one who wants Gladiator.
Precisely, and you're getting a bit of that. But I'm enjoying it. Up next on the programme, supply, beginning to pick up.
Yesterday, 19 million barrels of oil flowed out of the Strait of Hormuz. It's called an oil gush. Oil is going to come charging down.
We'll catch up with Dan Stuyver next of Goldman Sachs from New York City. You're watching Bloomberg TV. Check out crude this morning, pulling back once again. We're down by close to 2%, 75 on Brent, WTI around 72. Under surveillance this morning, supply beginning to pick up.
Yesterday, 19 million barrels of oil flowed out of the Strait of Hormuz. It's called an oil gush. Oil, for the first time in months, hit, think of it, $70 a barrel. So we got at 70. That equates to a very low price. Oil is going to come charging down.
Oil continued to fall, off more than 40% from its high during the peak of the war. Dan Stuyver of Goldman Sachs writing, we now assume that Persian Gulf exports normalised the pre-war levels by the end of July. We're reducing our 26 fourth quarter Brent forecast to $80. Dan joins us now for more. Dan, good morning.
Morning.
What happened to the post-war premium that so many people thought would stay in this price?
Yeah, I think markets are increasingly challenging that premium because the sharpest oil supply shock in history has somewhat ambiguous effects. Yes, I think we're learning that supply disruption risk is higher than widely believed. On the other hand, I think we're also discovering that there's potentially more flexibility in the system on the demand side, in the Middle Eastern supply picture from a pipeline perspective. And so maybe this idea that you need a very large sticky security premium is being challenged by markets right now.
So right now, do you see it continuing to rapidly decline because of the demand destruction that will stick in China, because of the increased barrels, because of the increased production from the UAE? What exactly are the factors that you see at play?
Yeah, I think oil prices are coming down pretty quickly for 3 reasons. One, reopening is going well and quickly. We estimate that total oil exports from the Gulf are already back at 60% of pre-war levels over the last week. Second, I think markets are challenging this idea that you need a sticky, large security premium for the reasons we discussed. And third, I think markets are putting some probability on the possibility that oil demand will be structurally weaker as a result of the shock. Our base case is that 90% of the 5% global demand oil losses that we saw in the spring bounce back, as has happened in the past, in 2022, 2011. But with the rise of EVs and EV sales are surging, it's a fair question to ask, how confident can we be that most of the demand comes back?
Is that China? Is that Europe? Is that also in the United States in terms of the structural demand destruction that's at play?
Mostly China, and then Europe. If you look at the 15 largest EV markets, 13 out of the 15 EV markets saw big increases in the share of EVs in sales since the start of the war, with a global average increase in EV sales of about 3.5 percentage points. But look at China. We had an 11 percentage points increase in the EV share of sales. It just seems that China is responding more quickly to the largest oil supply shock ever, and China crude imports remain down 40%. Our assumption is that if prices moderate, China will go back to the crude markets, start refilling inventories, but we can't be sure, and I think the market is testing that assumption.
Dan, on the heels of the OFAC waiver, where's the Iranian crude going? Still China, or do you think more customers will be willing to buy?
Mostly China, and I think that India is likely going to be the second most important buyer.
What do you make of the president basically saying oil companies are price gouging? It was in the middle of the night. You might have missed it, but he was up, looking at oil prices and saying this is where Brent and WTI are. Why are not gasoline prices across the United States falling as quickly?
Yeah, I think it has to do with the seasonality of gasoline prices, which tend to be higher in the summer. And in general, there tends to be a lag of about 10 days or so between wholesale prices on Wall Street and retail prices at the pump. And then third, structurally, we think that refined product markets are tighter than crude markets.
What did the bulls get wrong in the last 3 months? I feel like the industry's scarred a little bit. And by industry, I mean strategists who are looking at this situation, not necessarily yourself. What did everyone get wrong?
I think we, as a community of analysts, and I think also most investors, I mean, at some point, oil was at 120, have underappreciated the flexibility in the system, whether it's China oil demand, whether it is storage facilities and pipelines allowing the Middle East to reduce production losses, or third, the strength of supply outside of the Middle East. We estimate that global oil supply as of May was up 3 million barrels per day year over year, with very strong growth in places like Brazil and the US.
How powerful was the China pivot? How important has that been in the last 3 months or so?
Critical.
Yeah.
Chinese crude imports dropped from about 10 million barrels per day to 6. So that's 4 million barrels per day of less demand for crude. And you see it especially in the Middle Eastern grade prices. The so-called Dubai oil price is now in contango, meaning that you actually get a discount to buy a barrel now versus a barrel tomorrow because of the weakness in the Asian pull on Middle Eastern grades.
It's kind of crazy when you think about it, and you don't have to respond to this, but from a political perspective, China actually bailed out the situation for the president. Now, I'm not saying that was their objective. I'm saying that was the outcome, the consequence of their pivot.
Yeah, China helped actually the global consumer as well throughout all of this. A lot of things had to go right. Think about Bab el-Mandeb Strait. The Houthis didn't get involved. The fact that we had a glut, the fact that we are seeing oil in other places, we were able to run off inventories. But then, of course, the biggest, of course, was going to be China. They really have their thumb on the scale when it comes to the oil market.
It made a lot of people turn their focus away from the oil market to other critical minerals, rare earths in particular, because that is not something that can be replaced so easily. And one thing that Scott Bessent, Treasury Secretary Scott Bessent, said last night was, in today's economy, supply chains are the domain in which that leadership is tested. And ultimately, that, to me, is the stockpiling that we're now watching, not just oil.
Has the phone gone quiet? You're getting some nice rest now? Because I'm sure it was off the hook.
Time to look at other commodities, finally,
right,
including rare earths, metals. I'm excited. Resources are freed up.
It was bored of talking about crude as well.
Well, yeah, because this is where the actual action's going to be.
Dan, thank you. It's good to see it, sir. Appreciate it. Dan Stroyford there of Goldman Sachs, with crude in the low 70s and threatening to break into the 60s. We've got PCE data about 24 hours away. Equity futures this morning positive by 0.1% on the S&P 500. The second down of Bloomberg surveillance up next.
The hawks are squawking.
There tends to be this glass half empty view of where the Fed is going.
Markets are now pricing close to 2 hikes, followed by some easing next year.
It's more of a Fed on hold.
It makes sense to shift to a tighter hike-in bias.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Our next guest accusing Anne-Marie of being a part-time Knicks fan. Yeah. So this started well.
Yeah.
This started very well.
Fun. I think I should go take a break.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now with equity futures on the S&P 500 slightly firmer by 0.2%, following 2 days of losses on the Nasdaq up by 0.5. In the bond market, stability this morning, but anchored around 420 at the front end of the curve, 419.49. This from Neil Dutta of Renmark just moments ago. On the Fed, I heard a green light to hike from Secretary Bessent. Bessent, the Treasury Secretary, speaking in New York yesterday evening. We'll get to those comments in just a moment. Happening later this afternoon, this is the one to watch, the earnings story, Micron, as many people have called it a gut check for the tech trade.
Yeah, because we've seen so much volatility, particularly when it comes to semiconductors. Micron has been one of the single best performers in U.S. equity markets so far this year, has delivered one of the biggest percentage points to that increase so far. And you start to wonder, what can they deliver that will actually give people confidence that this can continue? Ultimately, what we've seen is when they deliver earnings, their shares typically over the past couple of quarters have tended to go down regardless of what they put out there. Does it sort of signal the next leg after what we saw in SK Hynix?
Or if they don't do well, is it potentially going to be more worries in this market? What's so interesting is we're talking about Micron, the way we would talk about NVIDIA earnings, setting the tone for basically this entire trade. The way we normally do it NVIDIA, it's now Micron's world. We're living in it.
It's a race for capital, and these companies are benefiting from all that capital that is being raised. SK Hynix, high-flying South Korean name, looking to raise equity here in the United States, $30 billion worth. SpaceX into the debt market in the last 24 hours. Just subtle signs of pushback. Major signs of pushback that are leading these companies to change their strategy, but certainly the market raising an eyebrow or two at some of these offerings.
The first time someone says, brother, can you spare $25 billion? You say, okay, sure, here you go. The second time, I don't know. And the third time when you start saying, oh, what are you going to buy it? What are you going to use it on? I don't know, go into space for 30 years. All of a sudden people say, wait a second, maybe we're going to make you pay a little bit more. This isn't pushback that is a deal breaker, but you did see investors start to demand a bit of extra premium, particularly for 30-year debt tied to space exploration. And I think that you really felt a sense that maybe people weren't as enthusiastic. The short end, a little bit more excitement.
So let's take the long end debt, trading wider by almost half a point relative to other similar rated debt. I found that interesting because I found that as evidence of the market questioning the rating that came from the debt agencies themselves in the last week. Maybe I'm taking it too far, but that's what I was thinking.
A lot of people actually were saying that verbally and articulating that. People in the market saying there was some skepticism about just how investment grade this company actually is. It is a lot of promise. It is a lot of hope. And hope tends to be more of the high yield regime, more than the investment grade regime. So you see it being priced more like a top tier high yield company, at least in the longer end. And right now, a lot of people are saying that's probably a little bit more in line with reality.
But for the bubble crew, that's the market that actually is discriminating, right? That's a market that's discriminating. We're seeing that at the equity level, too, for the hyperscalers, the likes of Meta, Microsoft. You're seeing that discrimination in equity and in debt.
This isn't a beer goggles moment. And I'm harkening back to that one Fed
In some places
speech.
it might be.
But maybe, but right, we can get into, no, we're not going to get into that later. But what I will say that right now, this definitely is a discerning investor base because people are clearly picking things apart and trying to see what exactly is backing each tranche and then saying, am I getting compensated
Have
for
you
it?
recovered? Are you willing to park your bias over the New York Knicks for our next guest when we start this conversation?
I'm ready.
It's going to be okay.
Ready
All
for
right.
Tom.
Coming up, Tom Becker of BlackRock with Micron earnings. Coming up a little bit later, Libby Cantrell of PIMCO with Bessent expressing confidence in Walsh, and John Servodea of JP Morgan on SpaceX's debut bond sale. We begin this hour with stocks looking for stability following a bruising two-day run for equity markets. Tom Becker of BlackRock warning of some immediate obstacles facing investors, writing rising stock and bond supply poses a medium-term challenge for asset markets given high valuations. Tom joins us now for more. Tom, good morning.
Hey, John.
Where are you seeing the pushback right now?
I don't think you're seeing the pushback necessarily, just like you were talking about. It's in aggregate, I think the IPO window's open. They're clearly taking advantage of that. I think in general, that is supportive of equities. It means sentiment's good. It means financial conditions are loose. I think the dereg agenda is sort of playing out where banks have more capital. They're facilitating this. On the debt side, it's a little trickier because each incremental debt issuance means interest cost that's going to eat into earnings. So we're a little more, bullish directional equities on kind of the equity offerings, but it's the kind of upping of the debt offerings a little more concerning.
I don't want to bury the lead here because you're looking for high yields on treasuries.
Yeah.
Are the two stories connected? Do they compete with one another?
That's crowding out. Yeah, so I think that's the big question, which is, will there be a point when government debt issuance and corporate debt issuance compete and drive aggregate yields higher? I think the big story of the last 2 months is the surprising strength of the U.S. labor market. That's when U.S. real yields started to take off, was the beginning of last month with the labor market report. People were like, oh, it's not just about kind of high inflation. It's actually an economy that's accelerating and maybe overheating, or closer to overheating than we thought. And so as real yields go up, it makes sense that you have higher productivity. It makes sense that you have more corporate investment opportunities. And so higher real yields are associated with an economy that's really booming. And I think that's sort of, that's where it looks like the economy is heading now.
Just to crystallize this, something that you said was you've taken down overall portfolio risk as the risk of an overheated economy rises. Are you seeing that risk as being in the bond market right now, not the stock market?
I think it's both. So I think, if you look at 2022 as an example, which is just higher real yields kind of weighing on all assets, I think that's what you've seen a little bit, some glimmers of these days when the data is a little too hot. The equity and bond market get worried about it. It's a persistent high stock bond correlation. And I think the labor market and the growth side is what's caught the market offsides. I think the U.S. outperforming to this degree post-Hormuz is not where people thought it was going to be at the end of Q1. And so it's sort of that stronger dollar, higher real yields. That's a bit of a pain trade for markets. And so I think we're just being a little cautious given multiples and valuations and positioning.
Does it make you more comfortable that the Fed had something of a hawkish tone, or at least was perceived as such?
I thought the Fed was actually pretty orthodox. I thought they went back to basics. There wasn't a lot of forward guidance. I think the forward guidance has proven itself over the last 2 years to have, missed the mark a couple times. The Fed took out too much insurance last year, it appears, because there was a bit of a false, concern about the labor market. And so I think that's back to basics. It does seem when you look at the dots, which, I don't know how much longer we'll have them, that there is now, a plurality that think that policy rates should be higher. The big question is, what's the mix going to be? And I think Warsh really laid this out, which is he's got his task force. The committee one is going to be less. The balance sheet one, the answer is going to be less. The inflation one, less. We want less of all these things. So it's this narrowing of kind of the scope. But the question is, how do they, if the economy really is strong and nominal growth is accelerating here, you're going to have to tighten some way. Which lever do you choose? Do you choose balance sheet first? Do you go with policy rates first?
Can I jump in?
Do you do dereg?
What would be less disruptive for risk?
I think given what's priced into front-end rates, if they delivered the two, the market would kind of be happy with that. I think the balance sheet is a big open question because a steeper curve, that's what weighs on kind of the long-end multiples for equities. So if 30-year bonds, took a leg up to, 530, 540, it's really hard to support these valuations with that terminal rate. So I think the balance sheet, I don't think it's going to be decided in the next month or two. It's going to be more about front-end policy rates because the task force has to work on it. So, but I think the sequencing of how the task force versus kind of every 6 weeks they have the policy rate, and so how are those two going to intersect? If we keep getting strong PMIs, strong labor market, strong retail sales, you've got the whole economy kind of performing well.
Do you think they'll be a touch less hawkish given where oil prices are now?
I mean, that would be a forecast, is to say, yeah, inflation, that was the high mark. Inflation is going to come down from here. I think the challenge with that is if you just look at services inflation, you look at core goods inflation, you look at kind of the core measures, they're stuck above 3. So, I mean, you're going to get some give back on headline from
A guest yesterday
commodities.
basically said that that's a high-end consumer problem.
Yeah, I mean, oil prices or services?
Services.
Yeah, I mean, Nickflation is a thing, right? Like New York, it seems like everyone has bought a new hat and is walking around in it.
Are you calling them part-time supporters?
By the way, I had this
Part-time
mug.
fans.
I used this mug last year as well, and I go in between Knicks and Yankees for the record.
I don't think he's convinced, but carry on, Tom, please.
But walk around New York, World Cup is a real thing. You've got people out and about in bars. They're flying into America to watch games. They're flying to America to watch games in bars rather than at the stadium. And so I do think there's a consumer element to this, which is surprising given where retail sales was in Q1. It looks like consumption is sort of picking up.
Earlier this year, people said that the growth would move away from the United States, and that became a diversifying trade.
Exactly.
Is this the violent reversal of that as everyone piles back into U.S. assets?
It looks like that may be, well, so U.S. assets U.S. equities outperformed post-Hormuz. And so the S&P is an outperformer since kind of, the invasion. I think it's more the dollar that is catching people out. So I think the U.S. real rate move is pretty large, and I think that's related more to growth. And so, yeah, I think that is, if it becomes another U.S. exceptionalism for multiple quarters, I don't think that markets are positioned for that.
Just a final word, Tom. Where have you got the Fed through the summer? Doing nothing, unchanged?
So our biggest shorts in the bond portfolios are in U.S. Treasuries. So we think Treasuries here, the path still looks too low. Relative to the rest of the world. So we've bought foreign bonds, we've actually stepped into gilts, we've bought Australian bonds, we've bought foreign bonds and sold treasuries because the growth, the inflation, and the positioning all make it look a little cleaner.
And do you think the Fed validates that pricing right now?
I think that's the big question is how he works the committee. And so I think just that there was one proposal and everybody got behind it.
Yeah.
But as you go through a couple more meetings, if the data are so strong, the tensions are gonna build, and that's how he's gonna have to manage it.
Tom, it's good to see you. Thank you, sir. You can make up in a commercial break. Tom Becker of BlackRock. Tom, thank you. Thank you very much, sir. There's some people who believe that the core of the Fed, Jefferson, Powell, Williams, did Walsh a favour by not putting their dots up and implying hikes. Bank of America wrote that note, I think, in the last couple of days, implying that they were doing him a favour because he just arrived at the Federal Reserve, and that maybe they won't be offering that favour further down the line in the next few meetings. And perhaps that's something to watch. Now, they're not going to reveal their dot. Of course they're not. They're not those kind of individuals, because Powell's never going to speak, and Williams is not going to tell you. And Jefferson's hardly ever speaks anyway. But that's the one to watch, I think, through the summer.
What I'm watching is the fact that the market's giving a green light. And just what we heard from Tom is that essentially this market is already baked in 2 rate hikes. If the Fed delivers on that, will it be disruptive, considering the fact that a lot of people have already priced it?
Might be less disruptive relative to adjusting the balance sheet. Let's give you an update on stories elsewhere this morning with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. In a symbolic rebuke of President Trump, the Republican-led Senate voting for the first time to end the war with Iran. The move signals disapproval of the conflict, although it's unlikely to force any change in the administration's strategy. Meta and Microsoft leading an $850 billion boon in data center leases, each company committing tens of billions of dollars in the most recent quarters. The future costs won't appear on the company's balance sheets until they begin making payment on them. France recording its hottest day on record as a heatwave grips Europe. Red alerts are in place across parts of Spain, the UK and France, with extreme temperatures disrupting transportation, schools and major tourist sites. And that is your Bloomberg brief. John.
Hey, Vonnie, thank you. Thank you for the update. Up next on the programme, growing confidence in the Hawks.
I am confident that the Fed chair will optimize the path for both inflation and economic growth.
A diplomatic Treasury Secretary. Up next, Libby Cantrell of PIMCO. Futures positive by a tenth of 1% on the S&P 500. On the Nasdaq, up by a third, bouncing back from 2 days of losses. Big tech rolling over in the last 24 hours. Just some signs of stability going into a big earnings report later on this afternoon. Under surveillance this morning, some growing confidence in the Hawks.
I am confident that the Fed chair will optimize the path for both inflation and economic growth. We are, I believe, on the other side of this conflict. Gas prices will come back down. Inflation will come back to target.
Here's the latest this morning. The Treasury Secretary, Scott Bessent, backing Fed Chair Kevin Walsh, predicting he'll get inflation back down to the central bank's 2% target as the US and Iran negotiate an end to the war. Bloomberg's Tyler Kendall has the latest from Washington. Hey, Tyler.
Hey, John. Well, an endorsement from the U.S. Treasury Secretary Scott Bessent of Fed Chair Kevin Walsh after the FOMC last week held rates steady despite the long-standing calls from President Trump for rate cuts. Bessent went on to say that the president does understand the need for independence for the central bank and added, as you've mentioned on this program earlier, that, quote, bond markets have taken out more governments than howitzers, an apparent reference to the economic and political consequences of inflation getting beyond the Fed's control. We are waiting for the PCE inflation reading this Thursday, which is expected to show the year-over-year rate at 4.1%, which is double the Fed's 2% goal and target. Bessent did, though, as you however, predict that inflation will come down now that the U.S. and Iran are, quote, on the other side of this conflict. But it still has the administration working overtime. Just yesterday, President Trump announced that the Department of Justice would be looking into gasoline prices, which he says aren't falling fast enough. John, the Treasury Secretary also defended his department's move to issue that temporary 60-day waiver to allow Iranian crude to market, as new data analyzed by Bloomberg News and out this morning shows a record number of ships are transiting through the strait with their transponders on, in a apparent sign that there is growing confidence among commercial shippers.
That is some good news, some better news. Tyler, thank you. Tyler Kendall there with the latest from Washington. Neil Dutta of RANMAC was in the room yesterday evening, as many of you were, listening to the Treasury Secretary, Scott Bessent, on the Fed. I heard a green light to hike. It's interesting how many different people are getting different opinions of this new Fed chair.
One thing that we're not getting is pushback, and I think that is speaking volumes, because in previous iterations of Fed speak, particularly Fed Chair Jerome Powell, there was a lot of pushback. He sort of timed it, looked at Truth Social, said, wait for it, here we go, too late, Powell, et cetera. But this time there really hasn't been that, and, you know, the sort of market whisperer isn't leaning into that either.
Wait. A few months?
Maybe.
Right, maybe.
Maybe, but right now, whatever. That's what we heard from the president.
Libby Cantrell of PIMCO. We haven't heard much. Libby, good morning. Good to see you.
Good morning. Good to see you.
Are things going to change at this institution, the Federal Reserve?
Well, look, I think this is, I'm not sure that was newsworthy. I think it would have been more newsworthy if he had undermined the President Trump's Fed chair. I think, what, of course, the hope is that with gas prices coming down, with inflation expectations remaining relatively anchored, at least, medium, long-term inflation expectations remaining relatively anchored, that the Fed will be able to at least stay on hold, if not at some point cut. And I think that the Secretary Bessent is understanding the power of his own kind of jawboning, if you will, reiterating the importance of the independence of the Fed, also projecting optimism that they will be able to keep inflation in check. And then I think with all of the hope that all of that kind of leads to a rate cut at some point. That is our view at PIMCO. We still think that the Fed will be on hold this year, but we do believe still that the first move of the Fed will be a cut, not necessarily a hike.
So do you think basically he's setting deterrence, anchoring inflation expectations, and likely this would have been communicated before he went out, didn't give a dot to this administration about maybe not exactly what he would do, but how he would like to present himself?
Yeah, I think you have to understand, kind of taking a step back, the pathology of Kevin Warsh, if you will. So I worked with him at Morgan Stanley. I think, this is sort of as part of my job. What has he been, what sort of animated him for the past, 15, 20 years? And he has been talking about honestly, a more hawkish bent to the Fed. One that is going to sort of first and foremost be focused on keeping inflation in check. And so in some ways, now that he is confirmed, as you very much know, he is a little bit protected. And now, of course, the president will jawbone. I'm sure he will. That has been, I think, people forget that this is a more modern norm, that we have better relationships between the Fed chair and the president. If you go back to, of course, the 1970s, 1960s, you had a lot of tension between the White House and the Fed. So in some ways, I think that's inevitable. But I think that, the bigger kind of picture here is that now he can, look at the data and he can adjust the Fed accordingly. I think the last thing I'll just say, sort of John's earlier point, is that we were expecting that, at least in style, he would make changes. On substance, though, he's just really beholden to that FOMC. Of course, he needs the majority of the FOMC, 7 votes out of the 12. 1 vote, important, but obviously not all powerful.
Task force, style or substance?
We'll see. I think, I think that's an open question, clearly. But again, many of the real substantive changes take either a vote of the governors or take, in most cases, a vote of the FOMC. So it's not just a question of, again, Warsh kind of jawboning or hamstringing the folks. He really needs to persuade, the rest of the committee, and so I think it's an open question.
One thing that Treasury Secretary Scott Bessent said was that he expects oil prices to come down, and as a result, he expects there to be some sort of natural disinflation that should right things as well. So it's not just necessarily the rate hikes. What do you make of the vote in Congress rebuking President Trump and sort of voting against the war powers after it was already over?
Yeah, this is obviously largely symbolic. A resolution needs 50 votes. Of course, though, to overcome a presidential veto, it needs 67 in the Senate. And of course, we're a very long way from that. But I do think that it sort of symbolizes the growing impatience among Republicans in particular of this conflict, and also just of the general relationship between the White House and Republicans in the Senate. Of course, President Trump, in an unprecedented way, campaigned against Republican incumbents in these primaries. He's also really made it much more difficult for Majority Leader Thune to get some really important things through, whether it's sort of the spy powers and what have you. And so I think it's sort of, I think, emblematic of just a general tension, but again, doesn't really mean very much because it is symbolic, because they don't have the votes.
Markets can really focus on one thing at a time, and right now they want to do tech, and they don't want to do Hormuz. They don't want to do politics. They don't want to do sort of gaming out what's going to happen with the midterms. Frankly, it's noise. Primaries, okay, tell me what the big takeaway is. Is there anything that has been developing when it comes to heading into the midterm elections, the elections that we just saw in a number of different primary districts, that you think are really instructive for markets, that people have to be watching and taking a greater note of?
Well, I would just say legislative there is. I mean, we should be talking about the housing bill that's about to get signed into law today. And it's interesting that the president's tweeting about gas prices and not tweeting about that, because this is an accomplishment for basically a do-nothing Congress. This is something I think that, I mean, again, incrementally may help supply. On the primary side, I'm actually I'm thankful for you didn't lead with the New York City primaries, because I mean, like, my social media is making lots of predictions about what this means, not only for 2026 but also for 2028 and 2032. But I do think it's really important to contextualize these primaries. Obviously, here in New York City from last night, Mayor Mamdani did very well, kind of went three for three, if you will. But politics are local, as we know. And this is the city that elected Alexandria Ocasio-Cortez, also elected Mayor Mamdani. So it is a liberal city. It also shows, though, that folks are angry with incumbents. And I think this is maybe the broader theme, kind of the signal from the noise. And this I think we'll probably see this play out in 2026 and in 2028. People are angry. Democrats were the casualty of that in 2024. I think Republicans will be the casualty of that in the midterms. People are angry about gas and groceries and housing and healthcare and now AI. So people do not think that the political class is working. And as a result, you have seen incumbents not do well in this primary season. But I think it's more of that than it is about socialists necessarily taking over
Libby,
America.
you say politics is local, and this is slightly uncomfortable to answer. Why is Israel such a big issue if politics are so local? Why is that such a big issue?
Yeah, and it's interesting because it's an issue in the most Jewish the most Jewish congressional district in America. Was, of course, when Dan Goldman was unseated yesterday, also replaced by somebody who has sort of been sympathetic with Israel, obviously has sort of tacked against it. I mean, I think, people, again, they're upset about the U.S.'s role in the kind of the world, and also, I think that Gaza continues to be a real lightning rod for Democrats, and then is exacerbated by the fact that we're in this conflict with Iran. So, I mean, sure, touche in terms of, obviously, some of these issues are more global, but the ability for these democratic socialists here in New York City to organize, to do these sort of real grassroots outreach, I think was part of the reason why they did so well last night.
Libby, Clinic, as always, good to see you. Thank you. Thank you. Libby Cantrell there of PIMCO. Up next, John Cervedea of JP Morgan on SpaceX's $25 billion debut bond sale. Equity futures right now bouncing back by just 0.1%. Not a strong bounce off 2 days of losses on the S&P 500. The epicenter of those losses in tech, in chips. The Philadelphia Semiconductor Index dropping yesterday by close to 8%. Biggest one-day loss in around 2 weeks or so, going into earnings a little bit later. We'll talk about that in a moment. In the bond market, switch at the board, 2s, 10s and 30s. 2s anchored around 420 this morning. Yields unchanged at 419.90. We've talked about this repeatedly. The Treasury Secretary, Scott Bessent, speaking in New York yesterday evening. raising questions about whether they've just given a green light for Kevin Walsh of the Federal Reserve to raise interest rates or not. Libby Cantrell of PIMCO was on a programme just moments ago, and she talked about the difference between style and substance. And I think they're the two camps right now following this Federal Reserve. Are we seeing a change in style or a change in substance with new leadership?
Right now, people are taking a look at the style and saying, yes, that. But clearly, on the substance side, it wasn't just the new Fed chair. It was also the members that are newly emboldened, not just to remove the easing bias, oh my, but also to bake in a couple rate hikes. And the idea that 9 of those members voted for that as the next move indicates where the mainstream on the Federal Reserve Committee is. I will say, though, the respect for the bond market coming from Treasury Secretary Scott Bessent gave people a sense that he's not going to push back. He doesn't want the howitzer on him.
He gets it. He knows what's going to happen. You get too dovish too quickly, bonds are selling off at the long end of the curve. They're not rallying.
This is a delicate dance. Right now, the market's giving a green light to hikes.
Let's turn to the bond market and then to the commodity market. To the commodity market, crude this morning backing off again, lower, 75 on Brent, 71 on WTI. We're almost wiping out the post-war rally. Diesel prices stateside dropping below $5 a gallon for the first time since mid-March. You see more of that, some better news going into the midterms for a White House shaken by a cost of living problem.
Absolutely, and it's why a lot of people think that if you do think there was the regime or the United States that blinked, it was the United States going into this. They didn't get all their red lines. They're only getting a willingness to talk about nuclear, and yet they were able to do this deal, which is why I think it's funny. To your point earlier, Lisa, the Senate coming out with this vote. Well, I'd hope the Iran war would be over, given the fact that the President of the United States has decided to no longer have sanctions on Iranian crude. So is that really a rebuke? Is that just getting in line with what this White House is doing?
I liked how Lisa asked the question while simultaneously telling us what she thought about the situation.
It was great. Pure Lisa. Honestly, I was just stating facts. Just the facts, ma'am.
The facts down in D.C. right now. Let's get you some facts ahead of the opening bell. 2 hours away from the cash open. Some single names, some morning movers. Yahara has more. Hey, Yahara.
Hi, John. We start with Micron rebounding 3.3% in the pre-market after a more than 13% sell-off yesterday. Made it one of the worst performers in the S&P, but that's now behind us, and all eyes turn to earnings after the bell, where revenue is expected to quadruple, while profits are forecast to be more than 10 times what they were a year ago. So expectations are sky high for this name, which has been the biggest contributor to the S&P's rally this year. Speaking of high expectations, FedEx, a casualty of that this morning. Shares are falling 6.7% in the pre-market, even though profit beats and it issued a solid sales outlook. But after rallying over 30% heading into this report year to date, investors were expecting more. On top of that, management is warning that tariffs and inflation continue to be a headwind. And we end on a fun one, and that is the fast food chain Wendy's. Shares are rallying more than 28% in the pre-market. Yes, they announced a shakeup at the top with a new CFO, but that's only part of the story. This name is gaining traction on Reddit's Wall Street Bets, with traders zeroing in on a 23% short interest and a possibility of a short squeeze. Wendy's down 25% year to date. So we have erased all those losses, and it is now positive for the year. John?
Massive bounce this morning. Yahara, thank you. Appreciate it. On our radar this morning, some of our top stories. 3 candidates backed by New York City Mayor Zohran Mamdani winning Democratic congressional primaries, defeating some of the city's most established political figures in a broad anti-establishment push. Elsewhere, SK Hynix seeking to raise nearly $30 billion by listing its ADRs on the Nasdaq. If successful, the deal would rank among the top 5 share sales of all time. The South Korean chipmaker expecting US listing trading to begin on July 10th. And finally, the president, Donald Trump, calling for a DOJ probe into gas prices, accusing oil companies of gouging consumers. Trump posting on Truth Social the following: gasoline prices better start going down a lot faster. Prices at the pump are up over 30% since the start of the war in Iran.
This is clearly the point, right? I mean, ultimately, this is hard for me to sort of not necessarily say so delicately. The point being, this was the whole point, right? Look, the oil prices are coming down. This is a stimulus. Here you go. And it sort of shifts the focus onto the oil majors, say, bring it down further. It doesn't really go to the question of Iran and Strait of Hormuz and barrels going through. And this is pretty textbook, especially heading into the midterm elections.
Whose textbook? the senator of Massachusetts.
It's
her
every
textbook.
look. It's every
Biden,
midterm
his
election.
textbook.
It's every midterm election. But this was the one stimulus that people could imagine going into the midterm elections. It's lower oil prices, and clearly they want that to go down more.
Price gouging, straight out of the textbook of the last 4 years, the previous administration.
So Truth Social is one of the places I do have to check every time I wake up in the middle of the night. And I saw this and I refreshed and I was like, is that a Donald Trump truth? Because price gouging against oil companies was the exact language the Biden administration used during their administration anytime prices went higher and after Russia invaded Ukraine, and then they tapped the Strategic Petroleum Reserve, which you call the Strategic Midterm Election Reserve. It was the exact same language of the Democratic Party that now Trump is using.
And it didn't work with the consumer then.
Nope.
And you've got to ask the question whether it works for the consumer this time around.
Well, oil prices are going down, regardless of whether it's any oil major or whether it's just simply that more barrels are going through the Strait of Hormuz. Can it go down quickly enough? Ultimately, that's what we.
Which is why I don't understand why he wants to pick a fight with the oil industry now. Gasoline is below $4 a gallon going into peak driving season. We are pretty much erasing the oil price spike we saw when the conflict started in February.
Yeah.
So I'm just confused why this morning, I think it was 12:30 a.m., he decided to pick a fight with Chevron, ExxonMobil, Marathon, et cetera.
Crude this morning down to 71, Brent at 75. Let's talk about the debt deluge. Facing some pushback, SpaceX selling $25 billion of investment-grade bonds and paying up to get it done. The company's bond maturing in 2036, pricing at a premium of 1.4 percentage points above Treasuries, roughly half a percentage point wider than the average spread on other BBB-rated debt. To discuss, a man in the know, joining us now is JP Morgan's global co-head of IG Financing, John Servidea. John, good morning, sir. It's good to see you.
Good to see you.
That's a bit of a gut check, I think, for investment-grade debt. How do you think things went in the last 24 hours?
I think it was another positive signal of the availability of capital. If you just take a step back, so far this year, we've seen 6 transactions of $25 billion or greater. In all of 2025, there were 2. So the scale of the capital needs continues to grow. Everybody knows that. What we're really encouraged by is that the market is available and understands that and is positioning themselves on the investor side to make thoughtful investment decisions to help finance this secular trend that is, not going anywhere.
For obvious reasons, we won't spend too much time on this one single issue. Don't want to get you in too much trouble. But further out along the curve, the longer dated maturity, just how much wider that was trading relative to other BBB-rated debt, other BBB-rated peers. What's the takeaway from that? Doubts about the credit rating agencies? How were you thinking about that?
The way that we're thinking about the market generally, and specifically to your question, if you take a big step back, and this is no surprise, but credit spreads are at historic tights. And so in our view, across the investment grade credit spectrum, there should be differentiation based on different ratings and credit profiles. So one of the things that I take great comfort in is the fact that investors are not blindly buying everything, right? Yes, there's a tremendous amount of capital being deployed here, but investors are taking the time to do credit work, to understand the stories, and to figure out relative value and pricing. So to me, it's a healthy sign for the market.
How nervous are investors getting about the concentration risk that's developing, given that so much of this debt is tied to the AI story?
Yeah, it's something we're clearly watching very closely. We're still at a point where there's a lot of capital available and investors are figuring out how they want to play this theme. Again, as I just said, this is arguably the biggest secular theme in any of our professional lifetimes. So as an investor, you have to be a part of it. The question is how. And so I don't think we're at a point yet where concentration limits are a huge concern, but it is part of the dialogue because you're absolutely right. As a proportion of the overall market, it is growing and growing very quickly.
This is a reason why you're seeing a lot of companies look to tap every single corner, picking up, quarters in the couch cushions of Canada and the couch cushions of Japan. Yeah. And at what point is this capital coming from other bond portfolios versus new pools of capital, whether it be cash, whether it be equities, whether it be private equity? I mean, how much are you seeing that really unleashed?
Yeah. Well, as a debt person, the really exciting part of this for me has been there have been a lot more coins in the couch cushions, right? And so if you look across the global markets, we've led the biggest Canadian dollar deal ever done, the biggest euro deal, sterling deal. So these other global markets, which have always been there, have grown in relevance in a very material way, such that the available capital is much larger, which helps the overall ecosystem in terms of how we finance these massive CapEx numbers.
What's most attractive if you're going to do one of these offerings outside the United States, out of all of these countries you're talking about?
It is a combination of diversifying funding sources and demonstrating that as an issuer, you won't be solely reliant on the U.S. corporate bond market, which remains the largest, deepest, most liquid by a lot. In certain cases, there's a pricing benefit to it. In certain cases, it's just establishing a new investor base so that in the future, you can go back there. So it really is, again, helpful in the context of we're still in the early or mid innings of this.
Does it worry you when a company doesn't have cash flows that really compensate over the debt and over the expenses that they have? And yes, I'm talking about SpaceX, but there are a number of them that are probably going to be coming to market. I'm thinking if this is a model, we could see something similar from OpenAI and Anthropic. Once they IPO, then there's going to be a follow-on debt offering. How important is it for people to see the show me, the money, the sort of the cash flows that can continue in perpetuity to overcome some of these huge debt piles?
Yeah, it's going to be interesting to see as the story plays out. And you're absolutely right that the cash flow profile of many of these companies is very different from what your average investment grade investor is used to seeing. The reality is our investor base is getting so up to speed on all of these stories in and around the IPO that I think they're prepared to deploy capital as needed pretty quickly. Again, it will play out over time in terms of cash flow profile or what the CapEx curve looks like relative to servicing the debt. We're not there yet.
John, you've been in the market a long time. How would you frame this moment historically? Have you ever seen anything like this?
No. This is, again, to me, this is the biggest theme we've seen in a very long time. What's particularly exciting for me as well is the level of creativity that is required to finance all of this, right? If you go back 1 year, there was a very predominant market narrative that the hyperscalers would finance a lot of this through free cash flow. From there to several hundred billions of dollars of debt issuance around the world, a lot of asset level project financing, equity issuance in 12 months, that's an incredible journey as a capital markets person. And so for us, thinking about how to raise this capital in the most efficient way requires a lot more creativity, a lot more product agnosticism. It's not just if your capital need looks like X, then go to this market.
They're getting creative, and I wonder if there's something on your dashboard that would trigger concern. I don't think we're there yet, listening to you right now, but what would come up on your dashboard that would say, think things have gone too far? When would the red lights start flashing?
The red lights would start flashing if it felt like there was blind euphoria. And again, it does not feel that way. Whether it's underlying credit work or in project financing where it's looking at the actual contract terms, investors are doing the work and understanding what's actually happening here. If you move it away from the AI ecosystem theme, what we're all watching is, and I said this at the outset, is credit spreads are just historically tight. If you buy a generic investment grade bond today, 85% of your coupon is the treasury yield. And so effectively it's an enhanced treasury, right? And so I think about what that means in a rockier economic environment.
Well, the question we've been asking is why are people so much more comfortable taking the credit risk when the additional yield is so small? And they seem to be more concerned about the treasury than they are the corporate credit.
Yeah.
Are you hearing the same thing?
Yeah, and it's interesting. Part of it is corporate credit fundamentals in general remain very strong, and so there's a comfort level with that. But there is also just a tremendous amount of capital that has to be deployed. But I do think, again, even within the investment grade universe, there is differentiation. But you're absolutely right. It is, to me, that's what we're watching. Is it's a historically tight spread.
John, it's good to see you.
Great.
Clinic, you're a guy that does the work, and it's great to hear from you. John Servidea there of JP Morgan. 85% of the all-in yield is coming from the Treasury. Now, we would typically say the risk-free component. Now, how risk-free that is part of the debate at the moment.
This is why people say when you start talking about all-in yield, you're talking about the Treasury yield more than anything. So at what point does that become an issue where people start to demand a greater coupon and you start to see some spread widening? I just think it's interesting that all the IPOs, they know that there's going to be a follow-on debt offering. I mean, everyone knows.
Inevitable.
And that sort of agnostic perception of markets. It's like you've got to be comfortable in every aspect and you need to be analyzing everything. It's a reason why no one's getting sleep.
No. Anne-Marie included. Just why she's so fired up when anyone questions her support of the New York Knicks.
I've been watching the Knicks even when I should have been sleeping.
Almost throwing the mug.
Well, I did go to
Tom
Game
Becker
3
earlier.
and I did go to Game 5. I'm
You
just
tell
saying it.
them.
I didn't see
Yeah.
Tom Becker at any of these Knick games.
They-
Actually, didn't go to any of them.
Write him a note. All right. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Bonnie Quinn has more. Hey, Bonnie.
Hey, John, thank you. Goldman Sachs equities traders are on track to generate record revenue of more than $5 billion in the second quarter. Sources telling us here at Bloomberg the unit has been bolstered by a boom in activity in Asia. Goldman also benefited from the record SpaceX IPO. SoftBank's Masayoshi Son says the AI revolution has only just begun and is calling it a bubble, and saying that calling it a bubble is an insult. 68-year-old Son now delaying plans for his retirement, saying he'd hold on to the top spot at the tech company he founded for at least another decade. U.S. Treasury Secretary Scott Bessent expressing confidence in newly installed Federal Reserve Chairman Kevin Warsh.
I am confident that the Fed chair will optimize the path for both inflation and economic growth. And the president said that at the Chair Warsh's swearing in that he would be independent, that he should do what he wants.
Bessent predicting prices will slow now that U.S. and Iranian negotiators are working to bring an end to the war. And that is your Bloomberg brief. John.
Hey, Bonnie, thank you. Appreciate it. Up next on the programme, waning AI optimism.
You have to have AI, hyperscalers, and OpenAI be able to build their revenues. And two, you need to build productivity in the economy enough for the capital markets to overlook all the disruption.
Up next, Jake Goldberg of Seaport, live from New York City. You're watching Bloomberg TV. Equities right now in the S&P bouncing back by a third of 1%. On the S&P up by a third. On the Nasdaq up by 0.6. Check out crude. Headline just crossing the Bloomberg terminal. A break of 75 on Brent crude for the first time since the war with Iran began. We are taking out the post-war rally on crude this morning.
I think it's pretty incredible given the fact that the Strait of Hormuz just recently reopened, and it goes to show really a lot of work that was done during this conflict. There was a lot of doomsayers saying, you know, it's going to be incredibly challenging. We were living on inventories, but now, Jonathan, we are back to where the conflict started.
And everyone else has moved on very quickly, just to focus on tech and the trade a little bit later. Micron earnings coming after the closing bell. Many investors hoping the results will reignite the tech trade. Mandeep Singh of Bloomberg Intelligence joins us now for more. Mandeep, welcome in. What are you focused on a little bit later this afternoon?
I mean, look, pricing is what everyone is focused on simply because we have seen the demand really take off, and all these companies have been slow with adding capacity. In fact, we're talking about, 35 to 40% quarter-over-quarter increase in pricing, not just for HBM, but also for DRAM. And I would say, Apple talking about raising prices of their phone was another testament to how the supply-demand mismatch is really percolating across the board when it comes to consumer devices.
Mandeep, this massive raise to raise capital, we've been talking about it throughout the whole of this morning. Now SK Hynix looking to come to the US to do it on the equity side. We saw it from SpaceX on the debt side. We're laser focused on this, Mandeep, their ability to raise capital. Are you seeing any pushback?
Well, I think everyone went in with the assumption that, input costs will come down, especially for, commoditized chips and things that have been a commodity for the past 2 decades. That hasn't seemed to happen. And, that's where some of the assumptions are being tested is, will the input costs of basic chips, whether it's power chips or memory or networking, because AI is very demand like memory and storage and all these chips, AI needs a lot of that. So when will the prices actually come down for the commoditized chips? That's what's being tested. And because of the compute intensity, it feels like it won't happen anytime soon because AI needs 10 to 100 times more of memory and networking than it used to in the past. And I think that's where the assumptions went wrong.
Mandeep, good to see you, as always. Mandeep Singh there of Bloomberg Intelligence, heading into these numbers a little bit later. The semis, the chip trade, in a bit of trouble in the last 24 hours. The Philadelphia Semiconductor Index down by close to 8%. NVIDIA, AMD among those leading this sell-off. Jay Goldberg of Seaport is the lone NVIDIA bear on the street, 180 price target. Jay, welcome back to the program, sir. It's good to see you. Are you seeing the story around this begin to shift, and what's behind that shift?
I think what we're seeing is a little bit of reality catching up with fundamentals. Like I think the overwhelming trade this year has been sentiment has been driving everything. Everyone wants to get in on the AI trade. I think there's been a lot of retail participation chasing the returns that investors have seen around some of these incredible runs that these stocks have had. And I'm a believer that AI is real. It's not a bubble exactly. The technology itself is very powerful and will yield benefits for the long term. In the near term, though, I think we could see some corrections just because things have gotten so far ahead of it.
Jay, what's the catalyst for that? Is it just the pricing pushback from some of the biggest buyers of these semiconductors, namely the hyperscalers?
I think what we're going to see is a lot of companies have gotten ahead of fundamentals, and we're going to see some of those correct this earnings season more than anything else, right? I mean, I look at some of the optical names. Like, we all know that there's a giant build out in optical coming for the AI data center, right? A huge increase in the size of the market, orders of magnitude increase. The problem is it's not coming until 2028, really. That's when the build out really starts. And optical technology is very difficult. In my career, I've been disappointed by optical many, many times. So the build is real, but the timing is going to be a little bit variable. And I think little imperfections like that will spook investors. And I think that will cause some form of reset to a little bit more reasonable trajectory.
To crystallize this, Jay, have we already seen the peak acceleration in earnings growth?
I think we're gonna. I think things will plateau a little bit, and some names will reaccelerate later. But I do think that there are. I think that's the prime concern around NVIDIA is what the question I get from investors most is what will the rate of decline and growth be next year?
That's the money question, Bramo, without a doubt.
Yeah.
I mean,
right. And sorry, go ahead.
No, I mean, to me, this is the key question, and that's part of the reason why people have anxiety. And right now, that's the sense that people have, is that it can't go forever. And at a certain point, we're reaching peak saturation where suddenly people are thinking about price again.
Hey, Jay, it's good to see you, sir. Thank you. Jay Goldberg there of Seaport on the chip players, heading into Micron a little bit later after the closing bout. Some price sensitivity coming into the supply chain. Bit of pushback here, there, and everywhere, further downstream away from these players.
Yeah, if you take a look at the token prices and how it's gone down in tandem with some of the names that you mentioned, like Microsoft and Meta, it starts to highlight how people are starting to rationalize their use of some of these AI tools. At the same time, people said this would have to happen. The price of tokens would go down, that it would be democratized, everyone would be using it. So these are some of the uncertainties people need to hash out, just the rate of change and whether we already have seen the peak in that.
How close are we to some of these hyperscalers pulling back on CapEx? Some deceleration there, so to speak.
This is why people were seeing some of the layoffs at the likes of that we had seen from some of these companies. Maybe headcount in favor of CapEx.
Interesting. That's the story we don't want right
No.
on the labour market side at all. Coming up next on the programme, Joe Amato of Neuberger, Gil Luria of D.A. Davidson, Francis Donald of RBC, Daryl Kronk of Wells Fargo. The third hour of Bloomberg Surveillance up next.
In 2 months, we've seen a historic melt up.
We still believe that most of what's powering the market is going to be earnings.
It's kind of the opposite of a bubble.
The near-term outlook for all the tech space is actually looking very, very good. The issue really is sentiment.
Volatility works both to the upside and the downside.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The third hour of Bloomberg Surveillance starts right now, and your price action looks like this. Futures bouncing back by a third of 1% on the S&P. On the Nasdaq, up by 0.6. On the Russell this morning, up by 0.4. Later on, earnings from Micron, the main event for this equity market after the closing bout. The main event right now, just check out crude. Oil dropping below $75 a barrel on Brent, down 3% this morning, wiping out the post-war rally of the last few months?
Yeah, a couple of things here. First of all, tankers are getting through the Strait of Hormuz again, and people are watching the tankers, not the rhetoric as much, and they're seeing something that they like. I want to bring back, though, what Dan Stuyven of Goldman Sachs said. I thought it was a really important point that they have seen a disproportionate amount of demand destruction coming from, in particular, China, but also in Europe, where people are buying electric vehicles. And the demand destruction is structural and is going to persist. And that, I think, is underpinning bullish calls, not just in the near term, but also 6-12 months out.
And even if you were going to look at the rhetoric and not the barrels, which are the most important to the oil market, and not just normal barrels that have been stuck, these vessels that have been stuck that are now being able to traverse the strait, but actually this administration allowing Iranian crude to sell on the open market at market prices, the rhetoric coming from this administration as well, talking about the fact that the president just this morning saying there are no tolls, that they're supportive of what's going on in the Strait of Hormuz. That also signals that they want to see this continuing, because the president also earlier this morning, 12:30 in the morning, annoyed with the oil companies because he wants to see what we're seeing on our screens in oil quickly move to the gasoline market.
He might be annoyed with the Federal Reserve a little bit later this year. Let's compare two things. Check out crude right now, the break below 75. So Brent at the end of February was trading in the low 70s. Big rally, big U-turn, all the way back to where we were. Got it. Turn to the bond market board and look at twos. The 2-year at the end of February was trading at 337. The 2-year this morning is trading at 418.26. We've had a massive repricing at the front end of the curve that has not done a U-turn in the same way crude has. It's more than just about oil. And this is going to be a problem for this institution, this White House, who's looking not just for lower prices, but also looking for lower rates, because that's not the debate in the bond market.
Core PCE is going to really underscore that when we get that tomorrow. The expectation is for it to come in at 4.1%, an increase from 3.8%. People are looking at some of the hottest components of that stemming from the AI trade and some of the components that people are buying that are feeding into that. At what point is this market endorsing the idea of rate hikes? And I say that because you are seeing the long end of the yield curve coming in. You're seeing risk assets, yes, having some wobbles and some concerns, particularly some of the high-flying names. Nonetheless, not exactly a wholesale rebuke of what we heard from the Federal Reserve.
Bit of curve flattening this morning. 10's down by 3, 2's down by 2. The 2-year at 418. Coming up this hour, we'll catch up with Joe Amato of Neuberger with stocks finding a firmer footing. Gil Luria of D.A. Davidson on the next big test for chip stocks, and Francis Donald of RBC as Besson is back in wash. We begin this hour with stocks bouncing back following a tech-fueled sell-off heading into earnings from Micron. Joe Amato of Neuberger writing, markets have priced in relief. They have not yet priced in the complexity of what comes next. Joe joins us for more. Jolly, good morning. Good to see you.
Good morning.
Let's get to the what comes next. $1 trillion question. What comes next?
Well, in a whole range of ways. I think you've got the Iran-U.S. situation, which I think is a fragile ceasefire right now. And I think people have put it in the rearview mirror a bit and moved on. You commented on oil prices, how significantly they've moved down. So, in the short term, that's good. I think we got to watch that because there's still a long way to go before a durable agreement is reached on that. Away from that, the economy is chugging along in a pretty good clip. And we're certainly seeing the continued investment. We're in the midst of a CapEx super cycle, which is massive, and that's going to continue for a while.
Oil has done that. It's gone up, it's come back down. Yields have done this. It's gone up, have not come back down. They've hung out up there. What gives?
I think that's an indication of the strength of the economy, and certainly a sense that the Fed is a bit more hawkish than might have been expected, right? With Chair Walsh's comments last week. So. Right now, if you look at the range of economists, there's a bunch thinking there's going to be cuts, there's a bunch thinking there's going to be hikes, and there's some that are like we are, which is you're going to see rates stay reasonably stable from the Fed fund standpoint over the course of into 2027.
How much does that impact the CapEx story at all, tied to AI?
Well, when you look at the companies that are spending all this money on CapEx, their margins are so massive, a modest increase, whether you're doing financing at investment grade rates at 150 basis points or 200 or 125, doesn't really matter that much in the scheme of things. So, I think there's a bigger issue driving that build out, and the marginal cost of financing, I don't think it's going to slow that down.
If you're an investor, why wouldn't you invest in the equity of some of these AI names and then treasuries? Because ultimately, you're going to get the upside then from equities, but you have the ballast of the income from the treasuries, and you're not taking the credit risk that comes if, say, we don't get to Mars by 2066.
Well, there's a whole spectrum of risk and return that you can invest in, and different strategies have a mandate around.
Bramo. Why do you want to buy SpaceX debt? Is that what you're getting at? Is half a point wide with another BBB rated debt enough compensation?
Is it?
Look, the market is pretty smart, right? So the supply-demand prices those financings. It was an interesting financing, certainly in the context of the amount of capital that was raised. And I think the broader picture is there is a massive amount of capital that's going to be needed over the course of the next number of years. When you think about the hyperscaler capex at $1 trillion plus going out a few years, you've got the defense build out in Europe. I mean, there's lots of capital demand. So I think that's also probably keeping rates a bit higher.
I remember some Tesla debt that was issued, 8 years ago? Do you remember that debt that was issued? And everyone was like, that's so tight, it's crazy. Look at Tesla and look at how things turned out.
Look, I've been skeptical with Tesla. I've been skeptical with Netflix. I've been wrong. I have been completely wrong. And these names have totally performed well. I guess, at what point do people start to get nervous when the demand to borrow is outstripping a lot of people's appetite to lend? And when there's so much competition, you start to wonder when people get nervous about that. And right now, it's evidently just me.
So the question you're asking is an important one. So right now we have a race for capital.
Right.
When does it become a competition for capital? Are you seeing signs of that showing up between, say, treasuries and elsewhere in fixed income and credit? Are we at that moment?
I think we're going to be at that moment over the course of the next several years as this capex build out continues to drive forward. So. There is a lot of liquidity in the system for sure, right? So I think that right now is keeping, the bond market reasonably stable. As much as the short end is repriced, as you talked about, long end has been surprisingly stable in the scheme of things. So, I think right now the market's receptive to that capital raising. These are companies that have incredible business models, unique business models, big moats around their business, but, that doesn't continue forever.
Well, in this kind of environment, though, how do you see inflation easing, even if we are seeing a significant drop in oil prices?
Well, I think you've got a few things going on with inflation. Our sense is that we've seen peak inflation, that it's going to grind lower as we move into the second half of the year and into 27. Right? We've thrown a lot of things at this inflation calculation. Right? We've seen tariffs, we've seen higher oil prices. We're starting to anniversary that stuff. So I think that's going to push inflation back down closer to the Fed target, but it's a longer road than what we might have assumed going back 18 months ago.
What's your read on the Walsh Fed? We had a range of views. Change in style or change in substance?
I think it's an important philosophical shift, and I think Chair Walsh is the right person for the job.
Yeah.
I think he is going to be more forward-thinking, and I termed it more forward-thinking than forward guidance.
Okay.
So looking more out the front of the windshield, not just in the rearview mirror about what the data is showing, and being more responsive to what's going on in markets. I think, if we think back to Alan Greenspan, rest in peace, right? He never had a press conference. He was in Fed chair for 20 years, never had a press conference, right? There was no forward guidance. So the Fed can function without forward guidance, and I think you want to get into a dynamic where the markets are not responding to what they think the Fed may do in the context of how their guidance may change, but more reactive to what actually is going on in the real economy. And I think that's what Chair Walsh is going to push.
Can you achieve that transition without substantial volatility in between? Toothpaste back in tubes will be something people are talking about.
I think every new Fed chair is tested in some way or another. We can go back over many transitions in the context of the market environments. But we have in Chair Walsh a very experienced Fed executive, right? He was in the midst of the biggest crisis we've had in markets in a long, long time, going back to GFC. So we have a lot of confidence. Like the market has a lot of confidence in him to manage that process. I think we're watching the balance sheet. The balance sheet is an important element, right? He's made clear that the balance sheet has gotten too big. So the process of rationalizing that, I think, is going to take a while. But I think there's a pathway there that's important for the market to appreciate.
To simplify that, you buying the dip? I mean, when people get some volatility here, you buying the dip, or are you thinking that ultimately we're heading into a more volatile period with Fed policy, with inflation?
What dip, right? We've seen an interesting last couple of days in segments of the technology market, particularly the memory space and the semiconductor space, where you had a lot of froth, you had a lot of piling on, you have a lot of leverage in that system. So rationalization of prices, I think, is a bit overdue. We'll see how markets respond to Micron's earnings this afternoon. But we've been on this broadening out theme for a long time, right? Which is as the economy broadens out in its economic development, take advantage of that. As companies adopt this AI technology away from the enabling companies, that's where the opportunities are going to be, not just in those companies that are producing chips or memory or things that are directly related to the AI build-out.
The 1.8% sell-off in the last 2 days on the S&P, that dip.
There have been big dips underneath there. I've been a skeptic about everything. But yesterday, my son graduated from high school, and there was a speech.
Congrats to him.
Thank you. That someone gave about how you know what to do when you want to get grades, when you want to get to college, then when you want to get into a certain career. But you don't learn how to take risk. And that actually taking risk with asymmetric upside is incredibly important. And that ultimately understanding how to take those risks, key. And I was thinking, I was like really listening.
Okay.
I was really...
This is terrifying again. Are you getting bullish again?
No, I'm not getting... No, that happened. I've already gotten enough hate mail for that one. It was really refreshing to hear about that. So it's important. And it's exciting and encouraging to see people
Congrats
dreaming.
to him, by the way.
Thank you.
And I've known him for a number of years, and he was ready to graduate like 10 years ago.
Well, I don't know about that. But it was interesting to hear some of the words of wisdom, and I was really internalizing them.
And best of luck for college to him and everybody else.
Thank you.
Joe, thank you. It's good to see you, buddy. Thank you.
Thank
Joe
you.
Martin there of Neuberger. Let's get you an update on stories worldwide this morning with your Bloomberg brief. Here's Vonnie Quinn. Hey, Vonnie.
Hey, John, thank you. President Donald Trump ordering the DOJ to look into gas prices. The president posting on Truth Social, the big oil companies are not dropping their price at the pump commensurate with the sharply lower prices they're paying for oil. Those prices are dropping like a rock. In other words, customers are being gouged. Meta is developing a prediction markets app called Arena. The New York Times is reporting the app would put Meta in direct competition with Polymarket and Kalshi. Now, users wouldn't wager money. Instead, they'd rely on a video game-like points system. Amazon Prime Day sales off to a slow start. According to a survey by market research firm Numerator, the average household spent about $89 as of yesterday afternoon, down about 16% from the same time during last year's event. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Thank you for the update. Up next on the programme, the Morning Calls, plus Gil Luria of D.A. Davidson with Micron earnings on deck in the next test for chip stocks. From New York City this morning, good morning.
Micron, such an important quarter relative to what we see in terms of demand. Ripple, what does that mean for NVIDIA, hyperscalers? Right now, demand and supply, call it 12, 15 to 1, which in my view just continues to believe like the chip trade is what you continue to own. You will see some push against price, but it's our view like over time, price comes down.
You're seeing that push right now. That was Dan Ives of Wedbush. Still bullish, of course. But we're raising concerns about the AI narrative as things starting to change. Equity futures at the moment bouncing back by 1/3% on the S&P 500, on the Nasdaq higher by 0.6. If we turn to fixed income briefly, 2s, 10s and 30s, your 2-year yield this morning at 417.85, down 2 basis points. Longer end of the curve coming in, we're down 4 on 10s. We're down by a little bit more than that on 30s, back down to 490 after breaching 5% a few times in the last few months. Helped out by this move. Crude down by close to 3% this morning on WTI, 71. And Brent, a break of 75, 74, 75 this morning.
Yeah, and you've seen that in terms of diesel come below 5%, $5 a gallon for the first time since the war started. At what point is this accelerating enough to give a further boost to the U.S. economy versus disinflation? And tomorrow when we get core PCE, that's going to be the key question. Are we seeing the peak in the rate of change of inflation, or are there other components that are now taking the charge?
This is pretty incredible that we're basically wiping away all the highs we saw and the significant increase in oil prices and energy prices right ahead of peak driving season and also travel season in the United States and around the world. And you can thank China for that.
Yep.
You can thank the jawboning, honestly, of this administration for that. On top of that, countries like the UAE that were able to still get some product out, probably with the help of CENTCOM. There was a lot more oil flowing than maybe even we realized during the height of this crisis.
Look, it's early days, things can change.
Definitely.
Admittedly, but the bulls had this view that we would have this post-war premium in the crude price. Maybe it's built in over time here. You don't see it this morning. Let's get you some morning calls. First up, Stifel lowering its price target on FedEx, seeing a lot of moving parts for the company after spinning off its freight division. Your second call from Morgan Stanley raising its price target on Cerebras, saying the company had a strong first quarter following its IPO. That stock is a struggle. We're down 8% again this morning. And finally, UBS boosting its price target on AMD, saying the outlook is becoming more positive for agentic AI use cases. That stock is up by 1.4%. Elsewhere, Micron trading higher in the pre-market ahead of its earnings this afternoon. The stock is up by close to 5%. Gil Luria of D.A. Davidson has a buy rating and $1,500 price target on the shares, writing Micron should be able to exceed consensus estimates easily, considering the increased demand for memory. Gil joins us now for more. Gil, welcome. It's such an odd story. The name is up by more than 250%. Now, typically after a move like that, I wouldn't ask a question like this. But Gil, is this stock still cheap?
Very much so. So to just put it in perspective, just 3 years ago, Micron generated $1 of earnings per share. By next quarter, they're probably going to be in a $100 of earnings per share run rate. And the simple reason is memory is not what it used to be. The importance of memory in AI is completely different than what it was before AI. Before AI, memory was just storage. It was a commodity component that was sold on an invoice by invoice basis. Now, memory is an important part of how AI models are delivered. The GPU needs memory at all levels in order to deliver the AI results that we're asking it to do, which is why there is such a shortage. There's really only 3 companies that make the high-end memory, Micron, SK Hynix, and Samsung, and it takes them a long time to bring capacity on board. So as Micron approaches $100 of earnings per share, and the shares are still trading at 11 times that number, that's not very expensive.
Gil, the nervousness comes after 269% gains so far this year. And as people take a look at how quickly things have risen and the fact that you can't see this pace of growth forever, what are you looking for to disprove the skeptics that, yes, this pace of growth isn't just ending, but is still accelerating?
They don't need to grow this fast. They don't need to grow 100 times over 3 years anymore. 11 times earnings is a very undemanding valuation. As long as they can keep this earnings power, they can justify this valuation. And there's much reason to believe that they can actually increase the earnings power from $100. Again, because the demand for memory continues to outstrip supply by a significant margin. And that's not going to change for at least the next year or two. So there's reason to believe they can continue to grow earnings from $100. They don't need to grow them very fast. As long as they're growing earnings over time, over the cycle from the current rate, they can justify a multiple that's twice as high.
Gil, how do you understand the story coming out of South Korea having to do with SK Hynix, the idea that they were de-emphasizing or decelerating some of their more expensive AI-related memory components in favor of accelerating their DRAM, which is used in pretty much all consumer products?
I think the right way to understand that is they benefit from there being a lot of supply at the high end. They understand that the high end, they're in an oligopoly with Micron and Samsung, and so scarcity there helps them raise prices. On the other hand, they have the threat of the Chinese coming in and providing memory for handsets and PCs, and they don't want that to happen because they know that it is always still a cycle, and when this cycle turns, they still want to have the biggest presence in the low end of the market. They don't want to cede that to the Chinese, which is why they want to make sure that handset makers and PC makers still have access to their chips, and that's why they need to increase supply there. So this isn't an indication of weakness of demand for high bandwidth memory, the high end, not at all. It's an indication of them strategically trying to keep Chinese manufacturers out of this market, even while there's scarcity, because they know at some point they want to go back to that market.
Well, what about the fact that we see Apple, though, having to raise prices because of just how difficult this market is becoming in terms of expense and also the ability to get a hold of these chips.
That's actually the best news we've heard from memory in a while. Up until now, Apple has said, don't worry about it. We get the insider price for memory. We're fine. It's not a problem. That's what they said the last couple of quarters. The fact that they're saying, no, we actually have to raise our handset prices, that's a permanent thing. That means they understand that memory prices have gone up and they're not coming back down. That is a very positive indication about the fact that memory prices where they are now, and as they continue to rise, are actually locked in for the next few years. Memory is no longer sold on an invoice by invoice basis. It's sold in long-term deals with the biggest companies, with Apple, Microsoft, Amazon, Google, Meta, et cetera. And that means that these higher prices are being locked in. That's actually very positive for these memory stocks.
Do you think that potentially is going to hurt Apple sales if they're going to have to raise prices of iPhones?
Absolutely. There has to be some demand destruction when prices go up. So that is a challenge that Apple's going to have to deal with. The good news for Apple is a $50 or $100 increase to the iPhone is a much smaller percentage than a $50 or $100 price increase on a lower end Android phone, which is their alternative. And so all other phones, all other handsets price is going to go up a lot more than the iPhone price is going to go. So from a competitive standpoint, memory prices going up is actually good news for Apple because it's going to make all the other products look a lot more expensive than Apple products.
Gil, just to put a finer point on it, though, if we've reached the point of demand destruction, how is that not bearish?
Because that's at the low end. Because that's at the very low end. Again, the demand destruction is mostly going to happen with the inexpensive commodity memory chips, where the high end, the high bandwidth memory, the chips that AI is running on, that's where the demand is headed. That's where the supply is headed, because these companies can generate far higher prices and far higher margins making and selling those chips. And again, that market looks to continue to grow. As long as the AI cycle continues to grow as it is, we're going to need a lot more memory proportionally, not just for the rate of growth that we're seeing in AI, not the rate of growth we're seeing in video. We're going to need to see a lot more memory growth than that because models are currently constrained by memory. They don't have enough memory to provide us with the optimal results. They can't get enough memory. And therefore, that high-end market's really where the value is at.
Gil, appreciate it, buddy. Thanks for clarifying. Gil Luria there of D.A. Davidson on the more constructive view here. It is amazing to sit here and talk about a stock that's up by more than 250% year to date. And we've got an analyst talking about why it's still too cheap. Kind of crazy. Difficult to get your head around.
This is a structural change where suddenly the concept of memory is shifting, and it's very difficult for people to keep up, which you've seen that in a lot of the tech space so far this year.
Up next on the programme, we'll talk about interest rates with Francis Donald of RBC as the Fed and the Treasury appear to align on a 2% inflation target and getting inflation lower over the next year. Equity futures positive this morning by 0.4% on the S&P 500. On the Nasdaq, higher by 0.6. On the Russell, up by 0.4. In the bond market, more on interest rates in just a moment. Twos fairly well anchored around 420, but yields declining this morning. More at the long end of the curve. We're down 5 on 10s, down 5 on 30s. And Lisa, we noted this last week, some curve flattening. Seeing it again this morning.
Yeah, back down to close to the lowest levels going back more than a year. A question if this is a good sign, given the fact that people were concerned about the long end coming unmoored, or whether this is taking away longer-term growth in the U.S. by tightening policy at the front end. Right now, we're not there yet. We're not flat. We're not through that. We're not inverted. Nonetheless, that conversation, I'm sure, will come up.
On the margin, happy to drive some of this move. This morning, at least, is this move in crude. WTI and Brent down 3%. WTI at 71. Brent crude a break of 75.
Break of 75, which means that we've erasing all the gains we saw since the start of the conflict. The Strait of Hormuz is open and more vessels that were trapped are getting through. And not only that, Iranian crude is legally, basically, allowed to hit the market now. So to what you guys have been saying, we've been saying all week, don't look at what everyone's saying, look at what's happening.
Yeah.
And it's more barrels on the market.
The barrels are moving. I've noted this a few times, we all have. It's very notable that we've had this round trip in crude and you've not had a round trip in rates. That the 2-year is still, what, 80 basis points higher than it was since the start of the war?
And we'll see that more clearly tomorrow when we get core PCE, because really that is the one that's been driven higher, not by oil prices, but really what we've seen in some of the components when it comes to hyperscalers and the CapEx build out. I will just note that, yes, you are seeing right now the tightest 2s10s yield curve going back more than a year, as people expect the Fed to still have a reason to hike even without necessarily that inflationary push from the oil prices.
2s10s at 27 this morning. 1 hour away from the cash open. Let's get you some morning movers, some single names. Yahara has more. Hey, Yahara.
Hi, John. We start with the main event today, and that is Micron. Shares are rebounding today, up 4.25% after a 13% sell-off yesterday made it the worst performer in the S&P. But all eyes now turn to its earnings after the bell, where revenue is expected to nearly quadruple from a year ago. So expectations are sky high for this name, which has been the biggest contributor to the S&P's rally this year. Turning to the AI chip maker, and that is Cerebras. Shares are falling 8.8% in the pre-market after it had its first earnings report as a public company. Revenue topped expectations, and its forecast came in above Wall Street estimates, but that not enough for investors after a blockbuster IPO, the biggest in chip history. And we end on Hertz, the rental car company. Shares are plunging nearly 20% in the pre-market after it issued preliminary second quarter results that came in below estimates. They say that rental demand is healthy, no surprise with the World Cup in full swing, but that losses on the sale of vehicles from its rental fleet will lead to lower earnings. John?
Is this all Freddie?
Maybe,
yes. Is it all Freddie
I think
making this happen? You've been tracking Freddie?
Yeah, I have, but he's not buying cars.
No, I'm talking about Hertz.
Oh, that Hertz. Their bookings are all good. No, but that's the problem with Hertz. I was actually looking at it, like.
I was just talking about.
Transportation, renting. No, I know. You were taking it one place. I just
people,
totally undermined you.
If Freddie is real, I love people willing to, give him a lift or buy his airplane ticket.
Freddie was going to miss his game.
I know.
And then everyone jumps in and starts offering him a flight.
How much PTO does this guy have? I mean, seriously,
well,
honestly,
he is German.
Independently wealthy.
You know, these Europeans.
European brand, you get the whole summer off.
Yeah.
June, August.
June, July, August. Why are we off?
June, July, August.
If you're not following Freddie, German football fan, apparently, because we still haven't seen his face, traveling America, loving everything about it and posting excessively on social media, and now everyone is gifting him things everywhere he goes.
Well, I love the excitement about things like gas stations and how big they are, especially in the Midwest or Michigan, and suddenly people
I
got very
did
excited.
just discover Buc-ee's in
did you?
in Texas, and honestly, I also was very excited about stopping at gas stations after learning about
I said this
that.
the other day. I love this country, and I love that the other Europeans are coming out and finding out what this country is all about.
It's all about Buc-ee's.
Not Buc-ee's, but you know my point.
No, it's true. All of the little quirks.
Let's talk about interest rates. The Treasury Secretary Scott Bessent backing Fed Chair Kevin Warsh.
I am confident that the Fed chair will optimize the path for both inflation and economic growth. And the president said that at the Chair Warsh's swearing in that he would be independent, that he should do what he wants.
The next read on inflation 24 hours away with PCE data just around the corner. Francis Donald of RBC writing, the new wrinkle in our outlook is Warsh positioning the Fed as keen to return inflation back to 2%. Should the Fed begin hiking, the heat under inflation may be more contained. Francis joins us now for more. Francis, good morning. Good to see you. Debate we've had so far this morning and over the last week is whether this is a change in style or substance, a change in policy or how we communicate policy. How would you describe it?
Certainly a change in style, and we'll wait to see whether it's a change in substance. But John, our take has always been follow the data. The data will tell us where central banks are going to go, give or take a little bias to one side or the other, 25, 50 basis points. And right now, the problem is inflation, which finally we have a chair of the Federal Reserve, which is calling it out. 30% of the CPI basket is running above, 40% of the CPI basket is running above 3% right now, including food, daycare, healthcare, even Pet services are running above 3%, way away from that Fed's target. And there is more inflation in the system outside of energy. This is a central bank that is going to have to contend with that. But more importantly, this is an American people that is going to have to contend with ongoing inflationary pressures in core services all the way to food. And this is a central bank that is finally acknowledging there is a problem here and something needs to be done about it.
Can they address the problem, Francis? How rate sensitive is that demand that's leading to this price pressure?
Well, this is the challenge. There is a lot of breadth under inflation. And who's bearing the challenges of that? Well, it's low and middle income Americans. And while our take has been that the inflation issue is not really an energy issue, that has been one compounding factor. What's happening under the surface is there are cracks starting to form amongst low and middle income Americans. That savings rate has dropped pretty precipitously since the start of the energy crash. We've seen an uptick in credit usage. Real wages have gone more negative. And so there are signs, yellow flags, I would say, for low and middle income Americans that are struggling. Now, if we raise interest rates, it's a catch-22. And this is a central bank that hasn't really had to deal with this challenge of the K-shaped economy, which is being divided by demographics and also by income uses. So this, I think, will be Warsh's biggest challenge, not inflation. If it was straightforward inflation and the regular pre-pandemic economy, you could hike interest rates, bring down. But now, with a very weak bottom 90% of American consumers, you hike interest rates just too far, you risk a much bigger slowdown in the consumer.
What's a bigger hit on the income of lower income consumers, Francis? Interest rates going higher or the way that inflation has ticked up in a number of different components?
I'm continuously worried about food price inflation, and a lot of our leading indicators tell us there is still some impact coming from that, from the conflict in the Middle East that will be more lagged. Food inflation is one of those pieces of inflation that Americans see every single day, and they cannot substitute away from it. Sometimes we see some moves from beef to chicken to peanut butter, but everybody has to eat. So keeping your eye on food price inflation is going to be critical. And here's the big challenge: is part of my job is to talk to everyone from hedge funds who are looking at headline inflation and how rates are pricing that in, but all the way over to CEOs. Now, markets are going to be very relieved because inflation has probably peaked in headline terms. And by Q2 of 2027, once we get to the summer of 2027, our call is that headline inflation will be sub 2%. But if you're a CEO running a business, particularly one that's exposed to consumers are still going to be struggling with price pain that isn't going backwards. So you're going to get a dichotomy here between headline inflation that maybe soothes the Fed, maybe soothes markets, but doesn't impact real America. And navigating that transition is going to be challenging through the rest of 2026 and into 2027.
Are you seeing any, for lack of a better phrase, trickle down from the hyperscaler investment, the CapEx, et cetera, to middle and lower income, just average consumers, given the fact that so much of the growth has really come from there? And if you strip that out, the U.S. would probably be in a shrinking type of condition.
Well, we wouldn't be shrinking, but we certainly wouldn't be close to 2%, which is about where we see the trend economy going right now. That 2% is coming, of course, from this massive infrastructure build out. It's also coming from big government and, of course, the savior of the headline consumer, which is that top 10%. What's going to continue to matter for consumers and why we think that the U.S. economy can persist at 2% is because the labor market is very, very tight. That will continue to be the most important thing. And the labor market is going to stay tight and has nothing to do, or almost little to do, with what's happening in AI. It has to do with mass retirements, a shrinking labor force participation rate, and a consumer that now is not going to be judged on whether they have a job or not, but are they making enough money and working enough hours in order to pay for life? So you've got many structural themes that are happening under the surface, and the core message I have for clients is don't use the pre-pandemic way of thinking about a cycle as a good element or a good way to think about where the economy is going to go next. These structural trends, from AI to labor force participation rate declining, are changing the way we have to think about the American economy, and it means that markets are going to react differently, and businesses are going to operate differently.
Well, when it comes to the Federal Reserve, I mean, Kevin Warsh said the monetary policy is somewhat restrictive in some sectors. Them raising interest rates is not going to hurt the AI build-out, but might continuously restrict those certain sectors like housing.
That's exactly right. monetary policy is a poor tool for an economy that is fragmented by sector, by income group. And we've seen this. We've seen central banks across the entire world who are struggling with what do you do when your regions look very different? What do you do when your incomes look very different? For now, the mandate of this central bank is price stability, and labor, but Fed Chair Warsh should maybe put that to the side for a little bit. And if your mandate is inflation, then that's what you got to target. So the biggest risk moving forward to me is not a huge move in the bond market. It's not a collapse of the U.S. economy. It's what happens to middle and low income Americans in a hiking environment. In our view, it's probably going to take a lowercase k economy and move it to an uppercase K economy.
Interesting. Frances, thank you. As always, Frances Donald there of RBC, framing this situation for this Federal Reserve, very focused on above target inflation. We are having this conversation about higher interest rates against a backdrop of higher targets on the S&P 500. This time yesterday, we were talking about Barclays going from 7,650 to 7,800 on the S&P year end. JP Morgan, earlier this morning, going to 7,800 from 76.
That is a 6% upside from where we are currently. So it's not exactly a runaway gangbusters type of forecast. Nonetheless, they said that year-to-date consensus on earnings growth has increased. They go back to earnings, which is what we hear again and again and again. And they go on to say, look, this is nonlinear. And I look at SK Hynix and I say, that's nonlinear. That's all over the place. But this is something that people keep coming out with. This isn't just sort of a runaway bullish call. This is things could get choppy. But if you take a look at the earnings, it seems to be delivering.
More nuanced view on earnings for next year coming from JP Morgan. Below current consensus, they say reflecting the risk of diminishing AI-related pricing power. That's a story potentially for next year.
Yeah, but people are saying that's not this year, but this is what people are seeing in terms of the fear. And this is what was underpinning some of the volatility, particularly with semiconductors. Are they starting to see the hyperscalers push back on price? Are some of the consumers that are borrowing bandwidth and large language models from the hyperscalers, are they pushing back on some of their token usage? And this is the story that's getting a little bit of anxiety, not for this year, but maybe 2020.
Dubravka Lekos Bujas and the team over at JP Morgan at 7,800 from 7,600 on the S&P 500. Let's give you an update on stories worldwide this morning with your Bloomberg Brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. A big win for New York City Mayor Zoran Mamdani. 3 of the Democratic Socialist mayor's favoured House candidates swept to victory, including former City Comptroller Brad Lander. He unseated 2-term Congressman Dan Goldman in the 10th district with almost 66% of the vote. SpaceX closing a $25 billion bond sale after raking in $90 billion in investor orders. The company's bonds maturing in 2036, pricing at a premium of 1.4 percentage points above Treasuries, roughly 0.4 percentage points wider than the average spread on other BBB-rated debt. In sports, Cristiano Ronaldo becoming the first player to score goals in 6 different World Cup tournaments. Ronaldo ended his scoring drought with 2 goals in Portugal's 5-0 win over Uzbekistan, giving him 10 career goals in the World Cup. And that is your Bloomberg Brief, John.
Tons of games later on today. Scotland, Brazil, 6 p.m. Eastern Time.
Are you going to be watching?
I'll be watching that.
Who are you rooting for?
We know.
We know.
We know. So why are you asking?
It's exciting. I think that it's really exciting. I mean, honestly.
It's a delicate story.
Yeah.
Okay.
Who's going to win?
Brazil.
He's voting for Scotland.
You'll get in trouble.
What do you think happens if you marry a Brazilian Bramo?
I know, it's
you
true.
support the other scene.
I mean, you could just, for fireworks, you know?
Hey.
Are you not entertained?
Happy wife, happy life.
It's true.
Peaceful home.
Go Brazil.
Brazil winning.
Yeah, he even has Brazil jerseys.
Come on.
I know he does. Everyone has Brazil jerseys. In Brazil, it's like a uniform.
Just ready to go. OK. Up next on the programme, setting you up for the day ahead, plus Darryl Cronk of Wells Fargo expecting a slowdown in economic growth.
The rate of change is going to be challenging for the market to sort of parse through and to contemplate on earnings for Q2. You know, can they really keep pace with this sort of 20+% earnings growth rate or not? And then you have overbought conditions. You have a lot of momentum out there.
That was Aaron Kennard of Clear Harbor Asset Management joining us on the program a little bit earlier. In the equity market at the moment, positive by about 1/4% on the S&P 500. The open about 42 minutes away. Your trading diary stacking up as follows. A few things, notable things to look out for. At 3:30 Eastern Time, you'll hear from the President. He's meeting with the NATO Secretary General Mark Rutte. After the closing bout, the main event for a lot of you in this equity market, earnings from Micron. We'll hear from the President again later this evening at 8:30. Tomorrow morning, very heavy program on inflation. PCE data just around the corner. Inflation is too high. It's why consumer sentiment is so low. You'll get UMich consumer sentiment going into the weekend. You'll get that data on Friday. Darryl Cronk of Wells Fargo expecting the S&P 500 to reach 7,900 by year-end, writing, our targets expect somewhat slower economic growth globally and a steeper yield curve through 27. Darryl joins us now for more. Darryl, good morning. Good to see you.
Good morning, John.
Where's that steeper yield curve coming from?
It actually, we think, probably comes from the short side coming down, the 2-year at 4.21, because we don't think the Fed and Chair Walsh are going to be able to raise interest rates like the bond market is priced in now, right? So we took out, obviously, from earlier this year, the 25 basis point cut that was priced in later this year. We put in 40 basis points of hikes. We took the 2 to 10 year spread from 73 basis points down to 28 this morning, right? It's too flat. It's too much of a flattener. We think the yield curve steepens back out, and we think long rates are too low. I mean, if you take the term premium, inflation premium, and growth premium and stack them, I get to a 5 number pretty easily on the long side of the curve.
Okay, let's deal with the individual parts of the curve independently. Okay. So that's the long end call. I want to deal with the front end. You said, I don't think they're going to be able to. What do you mean by being able to?
Well, $70 oil this morning, right? Inflation is going to come down, right? I don't think they're going to get to the 2.5% number that everybody else wants to. It's ironic that you watched oil come all the way down, which should put downward pressure on inflation, and yet yields have just stayed right where they are, right? They haven't budged a bit, right? Let's call the 10-year 4.5 and 4.21 on the 2-year, right? All else equal, those things should have been coming down as you reprice inflation expectations down, and they're simply not, right? Which is why the long end, we think it's going to stay higher. But eventually, can the Fed increase rates one time later this year or maybe 2? One time is just symbolic. It doesn't do anything really for monetary policy.
Well, do you think the communication of the last week is just symbolic?
Yes. I think it's part of Chair Walsh establishing his independence, new sheriff in town, right? And wanted that message to come through. Obviously, it's been well discussed, all about price stability. Didn't hardly utter a word about the labor market, right? Or anything associated with it. I do think the interesting thing, though, as we get into the second half of this year, is this kind of juxtaposition between economic growth, which has been really pretty soft, right? I mean, remember, fourth quarter was 0.5% for the U.S., 1.6% in Q1, and then you got this earnings growth that's 20, 25, 30% parabolic, right? You usually don't have that environment. It's a really unique environment.
How predicated is your 7,900 target on the S&P on the idea that the Fed will not be able to hike rates?
It's priced in there, yeah. I mean, I think we have 0 hikes for this year. So we have Fed funds staying exactly where it is. And part of getting to 7,900, in fairness, is that 0 hike. So if they hike the 40 basis points that's priced into the Fed funds futures curve this morning, then I think that number has to probably be lower for 12/31.
Do you think right now the equity market is saying we don't believe that the Fed is going to hike rates, and the bond market is saying, oh no, they're going to hike twice?
Yes, but that's always the case, right? I mean, and look,
so who's the smart money?
Everybody is so wound up, this week, this morning, yesterday, about this tech sell-off, and it's not a sell-off, right? I mean, if it was a true sell-off, banks wouldn't be breaking out, REITs wouldn't be breaking out, small caps wouldn't still be doing well, credit spreads would be more.
You think it's a rotation within equities,
not outside? It's a rotation within equities, and that's all it is, right? And you shouldn't play it for more than that.
Is it a buy the dip moment for these names?
Yes, but we think there's probably more weakness coming through the summer months, right? I mean, I do think when you get into Q2 earnings season, the bar is so incredibly high, particularly in the tech sector, that I think there's some disappointment there in price. You get into some seasonal period of time. So I think you'll get a cheaper moment to put that next marginal dollar to work in the tech sector than today, as we're sitting here. But we still like that sector overall as part of what we don't like is small cap. And what's interesting is, so Friday we're going to rebalance the Russell indices. The top 10 names in the Russell 2000 small cap all don't justify being there anymore. They're all above the high water mark for what they should be, right? So they should all graduate to mid cap or large cap or whatever. And that's 47% of your small cap return, right? So if you let that go, and they won't do that all at once, but if you let that go, you're just continuing to dilute the integrity and the quality of that index.
Well, let's finish with what you do like. I know what you like. It's financials. It's one of your core calls for this year. At times this year, it hasn't really worked.
It hasn't worked.
Why do you think it's going to start working?
All the fundamentals are there. Part of it is predicated exactly on what we were just talking about, the steepening of the yield curve, right? Because financials do very well on the steep yield curve. Obviously, when you look at the big banks that benefit from sales and trading and investment banking activity, that's hitting on all cylinders. We know what M&A is doing. We know the IPO environment.
Morgan Stanley, Goldman, those names doing great.
They're doing great. I think what's not doing great, it's ironic as you start unpacking, the financial sector at the lower levels. What's not doing great are the payment processors like Visa, MasterCard. What's not doing great is Berkshire Hathaway. What's obviously not doing great is some of the alternative asset managers. So it's a very, very bifurcated world. If I look at the large and regional banks right now, they're actually sitting close to highs and breaking out from here, right? But in fairness, it's still one of the few GIC sectors. As we came into this morning, there's 4 GIC sectors that are now negative year to date so far. Right? Most people wouldn't realize that when the market's been as strong as it has been.
It's true. Darryl, it's good to see you.
Thank you.
Thoughtful stuff. Darryl Cronk there of Wells Fargo. It's been really odd. You've seen big gains for the likes of Morgan Stanley, Goldman through much of this year. Up until recently, you had several big names in the sector trading negative on the year. Only just recently, Bank of America, JP Morgan now up by 4 to 5%, I think, for 26. Things starting to move, but big divide between those names within that index.
And they've been punished for actually spending more on CapEx and on technology, even as they see potentially investors talk about this as being something that is helpful in the long term. At what point are they starting to be rewarded? And ultimately, how much is that predicated on the idea of the steepening yield curve as well?
The World Cup later on this afternoon on Micron. I can offer you Bosnia versus Qatar at 3 p.m. Eastern time.
I mean, you know where I'm going to be focusing on.
Switzerland versus Canada.
Oh, I'd be interested.
Might be fun.
Yeah, that would be good.
You guys are trying to take any kind of heat away from Micron. This is going to be front row kind of box office
stuff.
You're making it the new NVIDIA.
Good stuff.
It is right now.
You're doing a watch party, Bramo?
I absolutely am doing a watch party.
Okay.
I think it'll be fantastic. We'll have little chip hats.
Nice. I'll be watching the World Cup. And then I'll read through the Micron earnings a little bit later.
What do you think? Like little black.
In one of those hydration breaks, so I'll read the Micron earnings.
Love it.
Okay. Coming up tomorrow, Sebastian Page of T. Rowe Price, Osen Kwon of Wells Fargo, Liz Ann Saunders of Charles Schwab, Stephanie Roth of Wolfe Research from New York City this morning. Good morning. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.